Happy morning, people. Oops, okay. All right. So welcome to the first session of our CA Intermediate Financial Management Marathon. So as we've told you, we'll be doing this particular session in Coimbatore for about 3 days. So morning 7 we start, we can go up till 3:34 or something. So leave the ending time to me, it might get a little extended. Okay. So before probably I will dive into the marathon, I'll just give you a quick overview as to what we'll be doing in this particular session. So first off, before that, so thank you for the amazing love and support you've been showing for advanced accounting and our previous FM marathon. Amazing, super duper love and support. It's adding a lot of pressure to us, obviously, but really, it feels good as well. So this attempt also will try to probably keep up the same momentum, if not better it. Yes. So thank you for that. So I think once we start the session, usually we get the queries like, sir, we'll be doing all the concepts, etc., of this marathon with the help of this colored chart book. So many students will say, where do we get this chart book from? If you want to buy our classes or for that matter chart book, you can visit our website. Once you go to ArivuPro.com, you'll be able to see something called ArivuPro online over here. Click on that and this page will pop in. There you have all the courses. The courses, the books, everything is available on the website out there. If you are interested to buy, you can buy it from there. Yeah. All right. Having said that, so now this particular marathon ka overview, what we're going to be doing. People in about 3 days, what we are planning to cover is all the FM. We know that mostly is driven by the formulas and formats. So we're going to revise all the concepts once. Okay, and then take up the questions and then apply that in a few questions. Questions will be based on a particular time. If we have time for each particular topic, I'll have a certain target in terms of hours, 2 hours, 3 hours like this. If we have more time, we will do more questions. Less time means little lesser problem. So that's the problem part. We're going to keep it based on the time. But concept, we're going to be covering everything. Is that okay with you? So overall, in about 3 days time, we should be able to cover everything. And last session, on the third day, we'll try to cover the RTP and MTP of this particular attempt as well. And that will be the Tathastu. Fine. So then we'll wind up. Okay, people. All right. So first of all, thank you for coming on time. So yeah, we started sharp 7. So at least we'll try to wind up a little early. All of you are woken up, Paka. All right. Fine. That's good to see. I think here, waking up is not a problem in Tamil Nadu belt, I think, na? Post 5 o'clock, I think you automatically wake up. I think even if you want to sleep, it's a little difficult, I think. Yeah. So even the sun automatically wakes you up. Hey, get up that times. All right. Fine. That's good thing. In Bangalore, mein ulta case. People sleep till 9 or 10 or sometimes 12 also. We'll have to literally wake them up. Hey, you wake up times. Okay. So we'll be starting with the first topic over here, people, and that is cost of capital. All right. Okay, so let's run through this. Sir, cost of capital means, sir, capital in FM means not your equity share capital, preference share capital. Capital in FM means the long-term source of finance. Now, to run a business, we need money. From wherever we source, we take up that money. From what source we can raise the money? Or from what and all we can pick the money? One, we can raise the money through equity share capital. Another one, preference share capital, or you can take bank loan, or we can issue debentures. So whatever long-term source of finance we picked up the money, the company has picked up the money, we call it in FM as capital. Okay, capital here simply refers to long-term source of finance. Now, will anybody give any money at free of cost? Will banker give the money at free of cost to us? No, there will be some cost. So every source of finance will have a cost. So this particular topic scope is simply to find out cost of each long-term source of finance. So basically in this particular topic, we have to only find few things. Cost of equity share capital, cost of preference share capital, cost of debentures, and overall cost of capital. Overall cost of capital means if you need money, will you pick money from one source of finance or multiple source? Multiple source. So we find average cost, that only we call it as what? Overall cost of capital, denoted by the symbol KO. And one more thing, we have to find something called marginal cost of capital, MCC. These are the only few areas where we need to find out, or this topic scope is all about. Next, if you'll have to look at the meaning. So cost here refers to not the actual cost, but the return expected by the providers of finance. Now, if you take money, if the company takes money from equity shareholders will expect a return, right? That expected return only is what we call it as cost here. For an investor, it's a return. For a company, it is a cost. For an investor, it is a return. Like if I take a bank loan, for me, it is interest paid, which is a cost. For a banker, it is interest received, which is a return or an income. So here, cost of capital simply means the return expected by the providers of finance. Now, first question may arise, sir, why should we find this cost? Like here, suppose company has issued debentures worth how much money? 10 lakh. What percentage debenture? 10%. Isn't this 10% only cost? Isn't this 10% only cost? Because how much interest company has to pay on this debenture? 10%. Correct? No? So isn't this 10% cost? No, sir. 10% is not the cost over here. Why? Sir, on debentures, when the company pays debenture interest for what? For a company, it is what? Income or expense? Expense. On all your expense, you get something called tax benefit. Hence, cost of debt will not be equal to 10%. It will be different, something different. Like just to be put up a scenario over here. Let's say EBIT. What does EBIT mean, sir? Earning before interest tax. Now, let's assume two cases. One when there is interest. One when there is no interest. Now, how much is EBIT? 1 lakh. How much debentures you have issued? 10 lakh. What percentage interest rate? 10%. So, calculate how much is the interest rate? 10 lakh ka 10%. How much is that? 1 lakh. Correct. Our simplicity purpose, I have just simply taken it as 10,000. Just for an example sake. How much is EBIT? 1 lakh. How much interest I have assumed? 10,000. Now, means from EBIT, if you reduce interest, what are you going to get? Earnings before tax. How much is that? 90,000. From this, reduce tax at 30%. 9 3s are 27. So, how much is the tax amount? 27,000. So, how much is your earnings after tax? 63. Correct? This is the number when there is debentures, meaning when there is interest. If debenture is not there, when will interest come or interest will not come? How much is EBIT? 1 lakh. Now, how much is interest? 0. I mean, check what happened to your EBT. 1 lakh. What happened to your tax, people? 1 lakh ka 30%. How much is the tax now? 30,000. What happened to your EAT or earnings after tax? 70,000. Concentrate on this number. When interest was there, how much was the tax amount you paid to the government? 27,000. When interest is not there, how much tax you're paying to the government? 30,000. That means what? When interest is not there, tax increased by 3,000. Do you agree with me? That means how much tax you are able to save because of interest? 3,000. Because of interest, you are able to see from 30,000, now tax's amount is only 27. How much tax you saved because of interest? 3,000. This is what we say by on debenture or on debenture interest, you get something called tax benefit. Now you honestly touch your heart and tell, though you are paying 10% interest, are you also not getting some tax benefit? On one hand, you are paying 10% interest. On another hand, you are getting some benefit. So is the cost really 10% for the company or something lesser? Hence, each source of finance cost we need to find out. It is not direct. That's the logic. Understood? This is not required for exam, just for the sake of our understanding. Yeah. So far, everybody good over here? Sir, though it is a marathon, I'll have frequent recaps with you. Would you be okay with that? Comfortable now? Okay. Cost of capital. Tell me, sir, what does cost of capital mean? Long-term source of finance will have a cost. That cost only we are trying to find here. So effectively, how many instrument cost we need to find here? Cost of equity shares, then cost of preference shares, then cost of debentures, then one more is there called cost of retained earnings, then overall cost of capital, and then MCC. MCC as in marginal cost of capital. So how many? 6. And cost here refers to the actual money paid or return expected. Return expected by whom? The providers of finance. Whoever is giving the company the money, how much ever return they are expecting. For them, it's a return. For a company, it is a cost. That cost only we are about to find out over here. Okay, Sarchi. Now let's dive into the first instrument. First instrument is long-term debt. Long-term debt, we call it, is denoted by what symbol? KD. KD. Okay, people. Now, cost of debt. Anybody remembers formula? Cost of debt. In order to first find the debt, we need to check whether the debt is a redeemable debt or a irredeemable debt. Redeemable debt means within a certain amount of time, the company has to repay. Like bank loan. Once you take a bank loan, can you keep it forever or you have to repay it? If you take a bank loan for 10 years, then company has to repay within 10 years. So if you have a term, if you have a fixed duration, we call it as what sort of a debt? Redeemable debt. If the term is not there, then it becomes what? Irredeemable debt. Now, if it is irredeemable debt, cost of debt is given by the formula. Tell me, let's see. It's a marathon. You must have already prepared once. So, cost of debt is given by what formula for irredeemable debt? KD is equal to interest. Interest or on interest you get tax benefit. So, hence what do? We don't take interest in the numerator. It will be interest into 1 minus tax rate divided by the net proceeds. A simple way to remember this formula is payment divided by receipt. What to? Payment divided by receipt. What is company paying? Interest. What is company receiving? Net proceeds. When the company takes a bank loan, company will pay the money or get the money? Get the money. Hence, a simple way to remember the formula is payment divided by receipt. But we can't take interest in the numerator. Why? Because on interest we get some benefit called what? Tax benefit. Hence, instead of interest, we take interest into 1 minus tax rate divided by net proceeds. Pakkana ji? Alright. Next to net proceeds. Sir, what number should we take as net proceeds? That depends. Depends on what? Whether it is an existing debt or a new debt. Whether it's an existing debenture or a new debentures. If it is new debentures or a new debt, first priority we will give it for IP. IP as in issue price. If IP is missing, issue price is missing, then we'll take up market value. Market value also missing, then we'll take face value. This is for new debt. If it is existing debt, first priority for market value. Market value missing, face value. Doesn't matter which number you take here, one component you have to compulsorily reduce. What is that? Flotation cost. You have to minus your flotation cost. Flotation cost means, name itself is saying flotation cost. To float the instrument or to issue the instrument, whatever cost we are incurring, that we call it as flotation cost. Now, when you want to take a bank loan, bank will process your document. For that, they charge some processing fees. All that becomes your flotation cost. So, basically, to take this money, if you are incurring any expense, that becomes flotation cost. Doesn't matter which number you take, flotation cost has to be compulsorily reduced. By doing this, finally, we get number. What is that number we get? Net proceeds. This is a formula for what, people? Cost of debt in case of irredeemable debt. Now, the next component. What is the next component? What is the cost of a redeemable debt? Redeemable debt means it will go on forever, or after some point of time you need to repay. After some years you need to repay. That could be 3 years, 5 years, 15 years, whatever. Question will specify. Tell me, how do you get cost of the redeemable debt? What's the formula? First part is same, or a simple way. What is a simple way to remember the formula? Payment divided by receipt. Okay, next. What's a numerator? Fill me up. Same as the previous one. Interest after tax interest. So you will do what? Interest into 1 minus tax rate plus RV minus NP divided by N, whole thing divided by RV plus NP divided by 2. Now what is this? What is this RV? Anybody remembers? We had discussed logic in class. RV is your redemption value. Now let's say, people, company is redeeming the debenture at 110 rupees. Company is redeeming the debenture at 110. You know, redemption can happen at par, premium or discount. Let's say net proceed was only 100. How much was net proceeds? 100. That means company borrowed from the debenture how much money? 100. But they're repaying 100 or 110. So that means company is paying same or more. How much more? 10 rupees more. If company is paying 10 rupees more, means for a company it is a benefit or cost. Hence this also be what? That means here company is incurring two costs. One in the form of interest. Another in the form of, this only we used to call it as premium on redemption of debentures and accounts, if you remember. Everybody okay now? Everybody good. Okay. Now this particular 10 rupees what the company is paying extra. This particular 10 rupees what the company is paying extra. It is for 1 year or term of the debentures. This is for the term of the debenture. How much number again we'll take? Let's say the term of the debenture is 5 years. That means how much is this number, sir? Calculate this for me. 10 rupees is the extra amount for 5 years. On average, 1 year, how much extra? 2 rupees. So that is what we take over here. Clear? Everybody good with this so far? Now tell me, this number is pakka actual number or average number? Average number. Since the numerator is average, mathematically if you want to compare, if numerator is an average, means denominator also should be average. Hence denominator also, the formula is not proceeds, we take average. We have two components, RV and NP. How do you find average of that? RV plus NP divided by 2. This is the formula and the logic for it. Tell me once again the formula. For if it is cost of debt, irredeemable debt, what is the formula? Irredeemable debt. Interest into 1 minus tax rate divided by net proceeds. And if it is redeemable, interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay. And there is one more catch in this formula we discussed in class. Now, why do we do 1 minus tax rate? Because on interest we get tax benefit. On interest we get tax benefit. Suppose the problem says, this is also cost, no? On this also, if the problem says we get tax benefit, what are you going to do? On this also, if this premium, no? On this also, if company says, if the question says we get tax benefit, what do you have to do? You have to multiply 1 minus tax rate to this also. Okay, and I think in this one of the RTP made, this attempt came. Till now that adjustment was not tested. I think now it came. I think we had discussed in class with formula, it was there. But just see. So if on this also, if there is a tax benefit, we will multiply simply 1 minus tax rate and do the number. Done, Aji? Okay. Any doubt so far? Can we follow the same pace? Would you be okay? Since it's marathon, I'll have to speak a little faster. I hope it's okay with you. Because I don't want to make it as a too much rubber also. So like that. Okay now with this so far? Done. And one more thing. How do you get net proceeds? That depends on what? Whether it is an existing debt or a new debt. If it's a new debt, first priority, issue price, IP. If IP is missing, market value. That is also missing, face value. If it is an existing debt, first priority, market value. That is missing. Then you will go for face value. Doesn't matter what number you take, flotation cost has to be reduced. Then finally only you will be able to get net proceeds. Now these two methods, we call it as approximation method. These two methods we call it as approximation method. There is one more method. What is that? IRR method. IRR method. IRR means what, people? Full form is internal rate of return. Sometimes they also call it as implicit rate of return. IRR is a rate at which present value of two things will be equal. What are those? Present value of cash inflow and present value of cash outflow will be same. Or IRR is basically a rate at which your NPV is 0. Now what is IRR ka formula? What is IRR ka formula? All of you, we call this as interpolation formula. What is that? In IRR, first of all, what do we do? Walk me through. We'll assume two rates. Is it mandatory to assume a specific rate or our choice? Our choice. We assume two rates. Ideally, I'd like to keep a gap of 4 to 5%. Like first percentage, if I assume 10, next percentage, ideally I'll assume 14 or 15, something like that. But is it mandatory or your choice? Your choice. So assume two rates, then apply interpolation formula. What is interpolation formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower. Fine, people. So by plugging in the formula, you will get particular number. That particular number only we call it as IRR. That IRR only becomes what, sir? Cost of debt. As simple as that. Correct? Now once we will apply if you want one problem, but maybe once we can go through. Okay. Now tell me, people, IRR. IRR is a rate at which two things are equal. What are those? Present value of cash inflow will be equal to present value of cash outflow. Outflow will happen later in now only. Outflow will happen now. Now in FM we call it as what? Year 0. Year 0 means now. Done. Alright. In fact, I told you. Remember? For IRR, we put the positive negative. Inflow we show it as positive. Outflow we show it as negative. This positive negative sign, we put it from company perspective or investor perspective. This positive negative, I told you in class that put it from the investor's viewpoint. From the investor's viewpoint. Now think. I am the company, I have issued debentures. I am the company, I have issued debentures to you. Will I issue the debenture certificate to you at free of cost or you have to pay me the money? You have to pay me the money. When? After 5 years or immediately? So right, immediately for you, there will be an inflow or an outflow. Outflow. But for me, that is net proceeds. For me, that is a Net proceeds. So at year 0 mein what you will take? Net proceeds. As what number? Positive or negative? Negative number, because we put this sign from whose perspective? Investor's perspective. From investor's perspective, when you buy my company ka debentures, for you it is an outflow. Hence the sign is what? Negative. Done na? Now every year what are you going to get because of debenture? Interest. Yes. But now this IRR calculation is done by the company or investor. Who is doing this calculation? Company only. Right? Company will take interest or after tax interest. So for year 1, let's suppose it's a term of the debenture is 3 years. Term of the debenture is 3 years. Will you take only interest or after tax interest? How do you get in FM a number on after tax basis? If you want to get something on an after tax basis, we simply multiply what? 1 minus tax. Hence we do interest into 1 minus tax rate. 1 year or every year? Every year. How many years I have assumed here? 3 years. So for 3 years you will take after tax interest. Third year mein what will happen? Third year mein redemption will happen. So company will pay the money, investor will get the money. Now I'm putting positive, negative from company perspective or investor perspective. From investor perspective, at the end of third year, you will pay me the money or get the money. So outflow or inflow? Inflow. So third year mein you will not only get interest, but you will also get RV. RV as in redemption value. Now this is your cash flow. Now assume any discount factor, 8%, 10% or whatever, and calculate NPV. How do you calculate NPV? All these are present value of cash flow. All these are present value of cash flows or future value cash flows? Future value. In FM, how do you get something on a present value platform? Take the future cash flow and multiply by the discount rate. These two, if you multiply, automatically you will get the present value. This is what? First number is what? Present value of cash outflow. What are these number? Present value of cash inflow. So that means what? When you add these, when you add this, if it exactly becomes 0, that is what? IRR. That is what? IRR. But do you think here you will be so lucky? No. IRR you will usually be in decimal. So it may be like 10.85 blah blah blah. So when you take a number, you will get, let's assume at 10% you got how much NPV I assume? 500. Now is this 10% my IRR? No. If 10% was IRR means NPV should have become 0. In my example, is it 0 or 500? Now we'll have to assume one more rate. Okay, na sir. Now in simple trick in FMS, now from 500 it has to become 0. So NPV we have to increase or reduce. NPV 500 from 500 we have to make it 0. So we have to reduce. If you have to reduce NPV means we'll have to increase the discount factor. As you increase the discount factor, NPV value will go on reducing. That means next discount factor I'm going to assume a lesser number or a higher number. Higher number. Let's assume I've taken it at 15%. When I did the same calculation at 15%, suppose I got it to be negative 50. I've got how much? Negative 50. So is this my IRR? Is this my IRR? No. If this was IRR means NPV should have become 0. Is it 0 or negative? That means IRR is somewhere between 10 to 15%. Somewhere in between this IRR exists. How to get that? Simply by plugging in these numbers in this interpolation, voila, formula. Lower rate. What is a lower rate here, people? I've assumed two rates, 10 and 15. Which is a lower rate? 10%. At 10%, what is NPV? 500. So that is your lower rate ka NPV. Divided by what? NPV at lower rate minus NPV at higher rate. Which is a higher rate here? 15%. At 15%, what is the NPV I've got? Negative 50. I have to reduce it. I have to reduce. And the number is already negative. Negative of negative will become positive. Into higher rate minus lower rate. What is higher rate? 15%. What is lower rate? 10%. Plug this number into the formula. Automatically you will get a rate that is only IRR. That only becomes cost of debt. Done, people? It was a simple walkthrough. We will spend time like this so that if you have understood, we don't have to solve any question. We can leave it here only. If you're feeling, now let's do one questions. We will do it provided we have time. But every concept we'll keep revising and formula will keep revising like this. That's okay with everybody now? Done. This is what people, till now what have we covered? First we have covered, first instrument. What is that? Cost of debt. Cost of debt. Debt here means what? Bank loan and debentures, everything. Everything becomes, in FMA we call it as debt. This is sorted. Can we move on to the next page? Next. Some 5-6 pages are there. If you cover that, conceptually it will be over. Then we'll move on to the numericals. Next to people, one more thing, in fact, if you have a convertible debentures, if you have a convertible debentures means what? Will these debentures be repaid in form of cash? Let's say the term of the debenture is 10 years. Term is 10 years. At the end of 10th year, will company give cash and redeem? No. The debenture will get converted into equity shares. Yes, no? That means how much is redemption value? Because are we paying cash here or shares? That means we need cash value or share value. Now you need to check the problem over here. If it is convertible debentures, first you will ask one question. What is it? Whether it is a compulsorily convertible debentures or optionally convertible debentures. Whether it is compulsorily convertible or optionally convertible. Optionally convertible means? Optionally convertible means investor has a choice. What choice? Either to take cash or to take shares. Either to take cash or to take share. Now you tell me, if I've given you a choice of cash or share, you will take the lower benefit wala option or higher benefit? Higher benefit. That's what this particular problem says. If it is optionally convertible debentures, we have to find redemption value of two components. What is that? Redemption of cash option and redemption value of share option. You'll choose the one which is lower or higher. Higher of the two, whichever is higher, that becomes your redemption value for our formula calculation. This is for what? This is for what? When it is optionally convertible. If it is compulsorily convertible. If it is compulsorily convertible, that is company giving a choice to investor or no choice? Now do you need two option redemption option or only one? Only one. What is that? Cash. Then if it is compulsorily convertible debentures, then we'll take redemption value of only what option? Share option. Both the types of problem we have done in our regular class. I hope you remember. Maybe if time permits, one problem I'll take you through this also. This is also good adjustment, so watch out. Do not forget to remember one subtle small adjustment here, which is what? Whether it is optionally convertible or compulsorily convertible. Only if it is optionally convertible, you will find two redemption value. What are those two redemption value once again? Cash option ka redemption value, share option ka, and take whichever is higher. If it is compulsorily convertible, then is investor getting a choice or only one choice? One choice. What is it? Shares only. That means in that case, you will find redemption value of only share option, and that only becomes RV as in redemption value. Now, next one, KP. KP means cost of preference shares. Sir, is cost of preference shares ka formula different or same? Same. But the only thing is, interest is an expense. Interest is a expense. On expense, we get tax benefit. But is dividend an expense or appropriation? Appropriation. Tell me the order. From EBIT, first you will reduce interest. What are you going to do? What are you going to get? Earnings before tax. From that you reduce tax. What are you going to get? Earnings after tax. Tax is already paid. Tax is already paid. Now you are paying what? Dividend. Now you are paying preference dividend. Now tell me, because of preference dividend, is there any impact on tax or no impact? Because tax is already paid. So on preference dividend, equity dividend, will we get tax benefit or no tax benefit? If there is no tax benefit, is multiplication of 1 minus tax rate required or not required? Not required. That means substitute wherever your cost of debt was there. No, from interest you will substitute with dividend. 1 minus tax rate you will consider or you will not consider? Tell me the formula. What is cost of preference shares ka formula? Again, first you need to check whether it is a redeemable preference shares or irredeemable. If it is irredeemable, simple way to remember the formula is what? Payment divided by receipt. On preference shares, what will the company pay? Preference dividend. So tell me the formula. Preference dividend divided by net proceeds. Preference dividend divided by net proceeds. For what? Irredeemable. If it is redeemable means preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Okay, now what about NP? What about NP? First priority for NP will be, again that depends on what? Whether it is an existing preference shares or new preference shares. If it is new preference shares, first priority for issue price. Next, if IP is missing, then market value. That is also missing, face value. Existing preference shares means first priority market price. That is missing, face value. Doesn't matter what you take, flotation cost you need to reduce. Anything new or same as debt? Same as debt there. Okay, perfect. Alright. Or these two methods, what do we call it, people? Approximation method. If you don't want to go for approximation method, we can also use what method? IRR method. Done, Aji? And sir, in exam, how to find out? Question will specify. If question doesn't specify, you will go for IRR or formula. Go for formula because that it will be less time consuming. IRR will take more time. So unless the question says IRR, don't use IRR, more time it will take. Now walk me through IRR. Went you through that, took you through that table. Same way for preference shares, construct a table for me. What you will take? What is the table ka format? Year, cash flow, discount factor. Then present value of cash flow. For IRR, we'll take one discount factor or one more. So second discount factor, at that second discount factor, present value. Okay. Now at year column, you will start with year 0. Suppose preference shares is for 5 years. Preference shares is for 5 years. You will start at year 0. Then 1, 2, 3, 4, 5. Then 5 again. At year 0, what you will take? You will take the outflow, right? You will take what? Net proceeds. Same, net proceeds. But the net proceeds, you will put it as a positive sign or a negative sign? Negative sign, because for a company, it is net proceeds. For an investor, it is a outflow. Hence, negative. 1, 2, 3, 4, 5. What is that? After tax dividend or only dividend? After tax dividend or only dividend? Only dividend. Which dividend? Equity na preference dividend. Preference dividend. Fifth year, you have to take again RV. The preference dividend and RV will be in a positive number. Year 0 ka net proceeds will be in negative number. Like this, at two rates may find out NPV and apply interpolation formula. What is interpolation formula again? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Fine. That's all. That's about your preference shares. Any doubt? Two instrument over. What's the third one? Cost of equity shares. Cost of equity shares is denoted by the symbol KE. Since equity shareholders are like risk takers, their risk or their expectation also will vary. Okay. Now currently, if you just check, market is falling too much. Correct? No. Now equity shareholders will expect very high return or they are happy with low return. They are happy with low return. Right? In recession environment, equity shareholders will expect less return. But when things are good, equity investors will expect very high return. So to find cost of equity, we don't have one method, we have multiple methods. First one is what? Dividend price approach. In name only there is formula. Dividend price approach means the formula is dividend divided by price. This method assumes that the dividend is constant. Every year company will pay same equity dividend is this method ka assumption. Next is earnings price approach. What is earnings price approach ka formula? Name only, again there is a formula. Earnings price. So numerator mein earnings as in EPS. Denominator mein price as in MPS. Now this method assumes what to be constant? EPS to be constant. Then Gordon Chacha. What is Gordon Chacha ka formula? Cost of equity is given by the formula D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by the growth rate. D naught means what? Dividend already declared, dividend already paid. We call it as D naught. D1 means expected dividend. D naught is dividend already paid. D1 is expected dividend. Now Gordon Chacha is actually used the same formula. Dividend price approach formula only is taken, but he made a modification there. What Gordon Chacha is saying is this dividend price approach, what did it assume? Dividend is constant. Gordon sir is saying dividend can never be constant. Now if you get 50 marks in this attempt, next attempt maybe we will expect, or CA final maybe we will expect same a little more. Same goes with that also. You can come in, ma. No issues. If you're coming in, just walk in. No need to excuse yourself. Now if you're getting 1 lakh salary now in a company in this year, next year you will expect 1 lakh only or more? More. So the expectations of equity shareholder can never be same. It will keep growing. Hence the growth rate Gordon sir infused in the formula. So hence D naught you take into 1 plus growth rate. D naught into 1 plus growth rate, if you do, automatically you're going to get D1 only. Divided by what? P naught minus flotation cost. Whole thing added by the growth rate. Fine now people. This is a formula. What is P naught here again? P naught again it's the same thing. If it's a new share, first priority will be your issue price. IP missing, then market value. That is also missing. Face value. If it is existing equity shares, first priority for market price. All that drama is same. But no matter what you take, flotation cost F, we need to compulsorily reduce. Okay, Ji? And that's your formula. Either this we will use or this we will use. When will we go for this formula, people? When dividend paid is given. When dividend already declared or paid is given. When will we use this? When expected dividend is given, if D1 is given, we will use D1 ka formula. Dividend paid is given means we will use D naught ka formula. What is G over here? G is your growth rate. How do you find growth rate? We have solved multiple ways to use growth rate. Anybody remembers? One is trial and error method. Let's say first year, the first year number was 100. Second year number has become 110. That means from 100, the number has become 110 means it has increased by how much? 10%. This only becomes growth rate. Like that. That is your trial and error method. Simply to test it at various percentage. You test it in your calculator at 5%, 6% like this. That's your trial and error. Another one, future value table method. If they give you future value table, maybe one question I will take you through that once again as a reminder. You can use that. The most of the problems in our exam we have, or in our class we have used trial and error method, if you remember. Okay. There is another one, the formula. What is that formula? In dividend decision topic, maybe we applied this. Anybody remembers? G is equal to B multiplied by R. B for retention ratio, R for rate of return on investment. If these two are given, by multiplying automatically we get the growth rate. So these are one of the ways to find, or one of the three ways to find out the growth rate. Which one you use, your choice. But any one of the things you can use. And that's your Gordon-Chachaka formula. Next to CAPM model. CAPM means capital asset pricing model. Okay, tell me sir, in capital asset pricing model, how do you get the cost of equity? RF plus beta into RM minus RF. RF is your risk-free rate of return. B for beta into RM. RM is your market rate of return. RF again is your risk-free rate of return. From RM minus RF, if you do, you get one number that we call it as risk premium. Sometimes in the problem, instead of giving RM minus RF directly, they can give you risk premium also. So watch out for that. Okay, now people, and that's your capital asset ka model. First of all, what does beta mean here? Beta measures the relationship between a particular company ka stock with market. Okay, let's say over here, just for simplicity purpose, our RBI bonds or government bond is giving how much rate? 7%. Now people, this government instrument ka rate, we call it as RF or risk free. Now government only is issuing this. Can they say this is a risky instrument? When government issues bond, and if they say that is risky, then it will be very demeaning for the government. Yes, no? So any bond or any debentures issued by the government or RBI, that is always considered as what? Risk free instrument. Now on government bond, how much interest you will get? 7%. Let's say market is giving you 15%. Nifty, Sensex is giving how much interest rate? 15%. Government is giving how much? 7%. But Nifty, Sensex is giving how much? 15. So that means compared to the government, is market giving more return? Compared to the government, is market giving more return? How much more? Market is giving 15, government is giving only 7. How much more? 8% more Sensex is giving. Agreed? Yes. Sir, if market gives 8% return means company also should give 8% more? No, that is only measured by what? Beta. Okay, if beta is 2, what does it mean? If beta is 2, what does it mean? If the market gives 1% extra return, this company will give 2 times of that, which is 2% more. If market gives 5% extra return, then this company ka beta is 2 means how much extra it will give? 5% cut 2, which is 10%. That's what beta is trying to measure. How much extra market gives and how much extra this particular company gives. That's only your beta. You don't have to really know the formula called logic. You need to only remember the formula for exam. What is that formula again, people? RF plus beta into RM minus RF. Sometimes instead of RM minus RF, directly they'll give you risk premium. Risk premium is nothing but how much extra return the companies or the particular market has given. Done. This is your CAPM. And now there is one more formula for your cost of equity. What is that? IRR. IRR you can call it, or you can also call it as realized yield approach. If you remember 2 problems we had done on IRR. What are those? One, if year-wise return, first you will check if year-wise return, if it is given or not given. Year-wise return andre? What does year-wise return mean? Every year equity shareholders will get a dividend, no? So if suppose you are holding equity shares for 5 years, you are holding equity shares for, or let's say 4 years. First year ka dividend, first year ka price is given to you in the problem. Again, second year ka dividend and second year ka price given. Third year ka, fourth year ka also dividend price is mentioned. If that is there, means we say year-wise return it is given. Year-wise return it is given. In that case, we go for geometric mean wala formula. Anybody remembers what is this? First year return is given by the formula or denoted by the symbol 1 plus y1 is equal to what? D1 plus P1 divided by P0. Similarly, if you know 1, you can construct the other one. Second year return is denoted by the symbol 1 plus y2. Construct this for me. Second year return will be what? D2 plus P2 divided by P1. Third year ka denoted by 1 plus y3. Formula is D3 plus P3 by P2. Fourth year ka it will be D4 plus P4 divided by P3. This is usually they'll give you 4 years ka return. You will be able to calculate. So multiply all the 4 and apply what? Root button. Nth root you have to find. N year means how many years your return you are able to find here? Fourth year. So you'll have to find out the fourth return. Multiply all this number and find out what, people? Fourth root. How do you find fourth root? In your calculator, there is square root button. There is square root button. If you want to find this is square root. Square root means 2. TV went off. What happened now? I don't know. No. Passcode. Anybody knows what to do? AirPlay password. Tab. Nothing here also is mentioned. Okay, maybe I'll just call her up. Give me a minute. She's busy on the call. No, we'll have to wait. It came, I think it looks like it. Hello, Lokesh, can you come down here, please? Yeah. Okay, let her come. Till then we will chill. There's a small technical error recorded, guys. Hang on for a minute. TV went off. Where's the TV car remote? That only, Yes. Just show me what to do there. Which HDMI? What are we selecting there? Okay. It gets timed out, is it? Frequently? Okay. It's a home. I can go for the home button and accordingly select, right? Yes. Okay. Fine. I'll keep that in mind. Thank you. Apparently not much of a break today to us. Okay, we'll come back. Okay, so we're discussing if year-wise return is given, we calculate through a particular way. What is that first year ka return again? Denoted by symbol 1 plus y1, given by d1 plus p1 divided by p0. Second year, denoted by the symbol 1 plus y2, given by d2 plus p2 by p1. Third year ka denoted by 1 plus y3, given by d3 plus p3 by p2 rather. Fourth year ka return 1 plus y4, given by the formula d4 plus p4 divided by p3. Multiply all of them and find out what? Fourth root. Why fourth root? Because we have to find out nth root over here. N here refers to number of years. How many years return you are able to find here? 4. So you'll have to find out the fourth root of this number. How do you find fourth root? This button is there in your calculators. This is called square root. Press this button twice. You'll get the number. Okay, now we have done this. So okay, I think maybe I'll talk about it when the question comes. So far, okay. If this data is not given, if this year-wise return, if it is not given, then you'll go for your normal IRR method. Done, Sarji? Let's do a thing. Can we do 1 or 2 questions on this immediately? And just to be on the safer side. 1 minute, it was there, not somewhere here. And now, come to question number 13. People will not be solving the question, we'll only be reviewing it. We don't have time. Alright. Now check this. Mr. Mehra had purchased shares of Alpha for how much value? 1000. And that means for Mehra, this is an inflow or outflow? He has purchased. So that means this 1000 is a outflow. He received a dividend for a period of 5 years at what rate? 10%. How much money he invested? 1000. 1000 ka 10% is how much people? 100 rupees. So dividend every year Mehra is receiving is 100 rupees. Basically 1000 ka 10% which is 100. At the end of 5th year, he sold the shares of Alpha for 1128. Now you would tell me the period of holding is 5 years. Okay. But they have given dividend for 5 years. Have they given price for 5 years or not given? All the 5 years ka price given or not given? Not given. That means can we use the geometric wheel mean wala formula or IRR formula? IRR formula. So here they are asking us to find out cost of equity using realized yield approach. But we will use what now? Normal IRR wala formula. Okay, take me through rather. Columns. First what? Year, or walk me through that particular table. First you will take what? Year. Then cash flow. Then discount factor. Then present value of cash flow. We need one discount factor or two. What is the discount dividend rate he is receiving? 10%. So first discount factor I'm going to assume 10%. Then this will not be the answer. I'll have to assume one more discount factor. Done, Aji. At year 0, tell me. At year 0, what we'll take? Net proceeds. Mehra purchased by paying how much money? 1000. For Mehra, this 1000 rupees is a outflow. For a company, it's a inflow. Or from company's perspective, we call this as net proceeds. That 1000, you will put it as a negative number or positive number? Negative number. Why? But signs we put it from whose perspective? Investor perspective. So 1000 will happen. When will the Mehra pay this 1000 rupees? Future mein or immediately? At year 0 mein 1000 will be negative. Done na? And for 5 years, Mehra will get a dividend. How much rate? 10%. 1000 ka 10%. How much is that? 100. I told you in the problem, if every year ka cash flow is same, should we have to use each year ka discount factor or club it up? That only we call it as PVAF, right? So instead of 1, we will write 1 to 5. So dividend will be 100. How do you get PVAF, people? How do you get this present value annuity factor? 1 divided by 1.1. Press equals to button 5 times. And then there is a GT button in your calculator. Press that grand total button. You should be able to get 3.7. In 5th year, Mehra sold the shares. How much money he got? 1128. That's your redemption value in a way you could say. Done. For this one you will take PVAF or PVIF. What is the difference between PVAF, PVIF? Each year ka discount factor. We call it as PVIF. PVAF means total of many years ka discount factor. Now when will you use PVAF? If every year if you are getting same cash flow, then we have a scope to use PVAF. This particular 1128, Mehra is getting every year or only once? If cash flow is coming only once, means we have to compulsorily use PVIF. Which year ka PVIF you will use? At 10%, you will use 5th year ka discount factor. How do you get that? 1 divided by 1.1. Press equals to button how many times? You want 5th year ka, so press it 5 times. Your calculator should show 0.6209. This is your future cash flows. Multiply the discount factor, you will get present value of cash flow. What is the rate we have assumed? 10%. Did we get NPV 0? No. If we get NPV by chance 0, then that only is your answer. Did we get it or we did not? Now assume another rate. What is the other rate? Now you tell me, sir. Now you will reduce the interest rate or increase it. Now I want my NPV from 79.37, it should become 0. So NPV I have to increase or reduce. NPV from 79.30, it has to become 0, means NPV I have to reduce. If you have to reduce NPV, means discount factor you will have to increase. Now let's assume you can take 13, 14 or whatever. And when we tested at 14%, when we tested, we got it how much? 71.36. Now is 14% my IRR? No, if 14% was IRR, means NPV should have become 0. It is not 0, it has become negative. So NPV IRR is somewhere between what? 10 to 15% or 10 to 14%, and plug this into your interpolation ka formula. That's all it is. Easy, no? This is pretty straightforward, no? You'll use this when year-wise return not given. When year-wise return not given. Now, can we go for another question? Now, check this problem. Question number 14. Calculate the cost of equity using realized approach only. They have given 5 years ka data. And check this number. Dividend per share and they have given price per share at the beginning. Each year ka dividend they have given, each year ka price also they have given. Now that means year wise return is missing, or we can find out. If each year ka price and each year ka dividend is given, means we will use normal IRR formula or geometric mean formula. Geometric mean wala formula. But do keep in mind, this is not price at the end of the year, it is price at the beginning. That means year, this 9 rupees is the price at the end of first year or beginning of first year? Year 1 beginning. In FMA, is there anything to represent year 1 beginning? Yeah, that only we call it as what? Not. When you use the word not, it means now. So this 9 rupees is not P1, it is P0. P0 means price at the beginning of year 1. This will be 9.75 is price at the beginning of second year. First year ka closing price will become second year ka opening price. So basically this is what? P1. This is what? P2. This is P3. This is P4. Yes, sir, people. Dividend, did they say anywhere? Like for share specifically, they said this is the price at the beginning. For dividend, did they say this is the price at the beginning? Dividend company will pay at the beginning of each year. Dividend will be paid at the end of each year, usually. Yes, no? I mean, this is what? This is D0 or D1? So D1 to D5 they have given. Clear, people? Everyone good? So now you would tell me, how many years return can you find out here? 5 years ka or 4 years ka? How many years return can you find in this problem? 5 years or 4 years? So to find 5 years return, we need 5th year ka dividend also available. We need 5th year ka price also. Is 5th year ka price available or not available? I mean, you can find the return only for 4 years. Yes, huh? So find 4 year ka return. Again, tell me, how do you find this? First year ka return. How do you get first year ka return? D1 plus P1 divided by P0. Calculate once for me. Let's see. D1 plus P1, 1 rupee plus 9.75. These two you add, divided by 9 you do. How much are you getting? 1.19. Correct, Aji? Like this, we do it once or 4 years ka? 4 years ka. So you did the same. And then what? Multiply. Multiply all the 4 years ka return. Find out what? Square root or nth root? Nth root. How many years return are you able to find here? 4 years. That means which root you need to find out? 4th root. How do you find 4th root? If you are not comfortable, if you want, you can try this in your calculator. Multiply all the 4 years ka return and press the root button twice. Press the square root button twice. You should be able to get 1.7276. Confirm that for me. Multiply all this number and press the square root button twice. Comfortable? Or if you are getting 1.7, 1.1464. That's what you're getting. Yes, no? Minus 1 you do at the end. You're going to get finally what number? 0.1464, or rather the cost of equity is 14.64%. Because of late, people, this is not tested much. That's the reason I've chosen to do this particular problem. Last 5-6 attempts I have not seen this question. Something which has not come way too long are expected soon in exam. Okay, so better be prepared for those. I'm not saying this will come. If it comes, amazing. Yeah, but just say, yeah, that's a usually I see a cut trend. And this is your realized yield ka approach. Easy now. So with this, what have we covered? Cost of equity also we have covered. Now can we go for the next one? So far, what and all have you covered? Cost of debt, cost of preference shares, then cost of equity shares. 2 or 3 more. What are those? Cost of retained earnings, KO and MCC. Can we go for cost of retained earnings? First of all, retained earnings means what, people? Retained earnings means profit which the company has distributed or profit which the company has kept with themselves. Whatever profit company has retained or kept with themselves, we call it as retained earnings. So how do you get retained earnings? From EBIT, tell me, how do you get retained earnings? From EBIT, if you reduce interest, you're going to get earnings before tax. From EBT, if you reduce tax, you'll get earnings after tax. From EAT, if you reduce preference dividend, we get net income or EASH. EASH means earnings available to equity shareholder. Yes. From this, if you reduce equity dividend, let's say EASH or net income is how much? 53,000. From that, how much equity dividend was paid? 20,000 I've assumed. So how much profit still remains? 33,000. Has the company distributed this final 33,000 or still kept with the company? This 33,000 only we call it as what? Retained earnings. Okay now. Everybody cool? Now you tell me, this 33,000 belongs to preference shareholder or equity shareholder? Equity shareholder. Now ideally, company should have distributed how much dividend to equity shareholder? 53. Why 53? Sir, after paying preference dividend, how much profit is available? 53. So this entire 53 belongs to whom? Equity shareholder, correct? No. So company should have paid how much equity dividend to equity shareholder? 53. Did they pay 53 or only 20? I mean, this 33,000, can I say shareholders have sacrificed their dividend in the current year for the sake of company's growth? Company is retaining this money because company is saying, I want to do expansion and all in future, so that I need money. So hence company is saying, I will not give equity dividend worth how much? 33,000. But this also belongs to whom? Equity shareholder. But did they get this 33,000 in the current year or they have not got? I mean, this 33,000 equity shareholders have sacrificed. Will anybody sacrifice an amount at free of cost, or they will expect some return on this? If equity shareholders have sacrificed 33,000 now, means on this 33,000 also they will expect a return. That only we call it as what? Cost of retained earnings. So equity shareholders have made a sacrifice. That sacrifice portion ka cost only we refer to as what? Cost of retained earnings. Done, Aji? That's the meaning. Now, since cost of retained earnings also belongs to equity shareholders, KR and KE ka formula any different or same? Same. Whatever formula you use for cost of equity, same formula you will use for what? Cost of retained earnings also. Walk me through. Earnings price approach. Using first dividend price approach, using, if you want to find KR, what's the formula? Dividend divided by price. Earnings price approach. Earnings by price. Garden chacha. D0 into 1 plus growth rate divided by T0 minus flotation cost. Whole thing added by growth rate. Correct? Wrong. Sir, for retained earnings, flotation cost will come. Flotation cost means what? To issue the instrument, how much cost you are incurring. You can issue equity shares? Yes. Can you issue preference shares? Yeah. Can you issue debt? Yeah. Can you issue retained earnings? Retained earnings is profit. Where can you? How can you issue it? Yes. So retained earnings you cannot issue. Hence flotation cost will come for KR or it will not come. So wherever flotation cost is there, consider that or cut it off. Cut it off. That becomes your KR ka formula. Okay, tell me again, Gordon Chacha ka KR formula. D0 into 1 plus growth rate divided only by P0. Whole thing added by growth rate. Flotation cost will not come. If they have given D1, the formula will be D1 divided by P0. Whole thing added by the growth rate. That's it. And is there any relationship between cost of retained earnings and cost of equity? Perfect. Sir, for cost of equity, there will be a flotation cost. But retained earnings will not have a flotation cost. You know, there was one formula. If you know cost of equity, you can find retained earnings. Anybody remembers what is that? How do you get KR? KR is equal to cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Okay, I've written it here any which way. Okay, so this also sometimes can be used. So because anyway, cost of retained earnings will not have flotation cost, no? So reduce that flotation cost. So from cost of equity, if you do 1 minus flotation cost, you will get it. TP is your personal tax rate. Personal tax rate of the company or the investor. It will be given to you in the question. Personal tax rate is 20%, blah, blah, blah. Take that. Using that, you can find out what? Cost of retained earnings. Another way to find out retained earnings. So far, any doubt, people? All okay? And now, next is KO. KO means overall cost of capital, or they will also say cutoff rate, hurdle rate. It is denoted by what symbol? KO. Overall cost of capital denoted by the symbol KO. Now, what is this overall cost of capital? Now, if you look at it, let's say, sir, company wants to do a particular project and project needs how much money? 100 crore, I've assumed. Now, company feels of this 100 crore, 30 lakh, we will take it from the debt. And that means balance 70 lakh, the company is saying we'll go for equity. Like, yes, no, is it mandatory? Entire 100 crore should come through debt, entire 100 through equity, or any combination is okay? Any combination is company ka choice. Here, company is saying 30% of the money we will go from debt, 70% of the money through equity. Okay, na, Sarji? Now, let's say KD, cost of debt is 10%. Cost of debt, I've assumed it to be 10%. What is cost of equity? 15%. Now you tell me, should this project be rejected or accepted? Let's say project ka return is 14%. Project ka return is, sir, if you're doing a particular project, company will expect a return. How much return company will get by doing this project? 14%. But in order to do the project, company needs money. And from what source company is raising money? One source or two source? Two source. What are those? Debt to equity. What is debt ka cost? 10. What is equity ka cost? 15%. Now, should the company accept this project or reject this project? Easy decision or difficult? Straight away, can you compare and decide? Because here we are taking one source of finance or multiple source. Hence, to take this decision, we compute another one called what? KO, overall cost of capital. KO is nothing but your average cost of capital. It's nothing but your average. But it is not simple average. It is not simple average. Sir, how do you find simple average? 10 plus 15 divided by 2. 10 plus 15 divided by 2, if you do, I think you will get 22 or 12.5. 12.5 you will get. It is not simple average. Why it is not simple average? Name itself is saying it is weighted average cost of capital. Why can't we use simple average? Because company is borrowing the money 50% from equity, debt or different amount. 30% money came through debt. 100 ka 30% is 30 crore, na? And 100 crore ka 70% is 70 crore. So company is borrowing the money equally or in different proportion. Different proportion. Hence we don't use simple average, we use weighted average. Done, sir? So hence WACC is the component. Now walk me through. For WACC, we had a table. We used to solve all the problems through table. What is that? Source of finance. Then market value, book value. Then weights. Then after tax cost of capital. And then finally KO. Okay. Now people, let us say in this problem only, how much money you needed? How much money came through debt? 30 crore. How much through equity? 70 crore. 30 crore and 70 crore. So totally how much money? 100 crore. Yes, Naji. Now tell me, what is this basically weights trying to calculate? Totally how much money are you raising? 100 crore. In 100 crore, how much money came through debt? 30 crore. Out of 100 crore, 30 crore has come through debt means what is the percentage of money of borrowed from debt? 30 divided by 100 into 100, how much is that? If you want it in percentage, we'll multiply by 100. If you want it in decimal, we'll simply do 30 divided by 100. How much is that? 0.3. Similarly, what is equity ka weightage? 70 crore divided by 100 crore, which is 0.7. Okay, ji. Now take that instrument ka cost. What is the cost of debt I have assumed? 10. What is cost of equity I have assumed? 15. So that is your after tax cost of capital. Done now. How do you get KO? How do you get KO? Take that instrument ka cost multiplied by that instrument ka weight. Like it's simply telling 10% will be the total cost provided 100% of the money has come through debt. And here 100% of the money has come through debt or only 30%? 30%. Hence you take that instrument ka cost and multiply that instrument ka weight. So you will get this number. Similarly, 15% will be the cost if 100% money has come through equity. 100% has come or only 70%. So hence multiply these two, you will get it. So finally adding these two, you will get overall cost of capital 13.5. Yes, sir. Now you tell me this project should be rejected or accepted. This project is giving how much return? 14%. But what is your overall cost to do this project? Cost is 13.5. Return is 14. That means benefit is more than cost. So project should be rejected or accepted. So to take the decision, KO will be very helpful. That's the reason we compute. And this is how we compute. Any problem? Now what is this market value, book value wala drama? Book value means the value of debt and equity as per our accounts. As per our balance sheet, whatever value is there, that we call it as what? Book value. Sir, in accounts we follow historical cost model. In accounts we follow historical cost model. Like land, I purchased for 10 lakh. I purchased the land for 10 lakh. Land do we depreciate? No, that means land will be shown in our balance sheet at 10 lakh. I purchased this land 5 years ago. When did I buy? 5 years ago. But now also my land value in my balance sheet is 10 lakh only. But is its market value now also 10 lakh or different? Different. So market value, book value will be same or it will be different? It will be different. So hence the weights can be calculated either using market value or book value. What's the first priority? First priority is always market value, because market value is latest data. No? Book value is old data, because you might have issued this instrument 5 years back, 10 years back. Book value is old data. Market value is most recent data, right? So always we give priority to the most recent data. What is the recent data? Market value. So hence, in fact, many question will specify. You'll have to calculate KO using book value or market value. Question will mention, right? If they don't mention, first priority will take for market value. If market value is missing, then we will go for what? Book value. That's how we'll do the selection. Done, Asarji. Now, last concept before we dive into the question. Can we go through that? What is that last concept? MCC. MCC ka full form is marginal cost of capital. Okay. Marginal cost of capital means what? Cost of, same only. Marginal cost of capital is also KO. KO only it is. But it is not the KO for total fund. It is the KO for additional fund. Only for additional finance, if you calculate KO, that we call it as MCC. Just to give you an example over here, check this. Let's say people, company has 10 lakh equity, 5 lakh debt. What is the total capital? 15 lakh. This is already existing. For this existing instrument, if you find KO, we call it as what? WACC. What is WACC ka full form again? Weighted average cost of capital. This is for the existing. CE means what, people? Capital employed. For existing capital employed, if you find KO, we call it as WACC. Now, company raised new funds. They want to do a new project. For that, they need a new fund. So, how much new funds they need? 30 lakh. Of this 30 lakh, how much came through equity? 20. How much came through debt, I assume? 10 lakh. Only for this, only for the new funds, if you calculate KO, only for this new funds, if you calculate KO, we call it as a new term called what? MCC. Only for this, if you calculate KO, we call it as marginal cost of capital. Any problem? Now, sir, tell me what is the total, revised total capital employed now? How much equity we had? 10 lakh. How much extra we raised? 20. Now, how much we have? 30. Similarly, how much debt we had? 5. Now, how much we raised? 10. So, totally how much? 15 lakh. Correct? So, total capital employed 15 plus 30, how much? For this, if you find KO, for this again, if you find KO, we call it as MCC or still WACC? WACC. Because this is only new or new plus old. Whenever you are finding KO for old or old plus new, it is KO. Only for the new instrument, if you find KO, we refer it to as MCC. That's all. That means MCC ka calculation pattern any different or same only? Same only. So calculation mein there is no difference. Just the terminology, Namadaya, Namakarana is different. New Namadaya, that's all. Done, people. This is problem specific pointer. I'll take you through that same question once again. So I think one more is there. I'll run you through that. Now, one more. Now, people, check. There's a question specific adjustment again. I think we can understand this. First, maybe this. Sir, how do you calculate debenture interest? Walk me through. Forget what I've written here. Tell me, how do you calculate debenture interest? You take debenture ka value multiplied by the interest rate. Yes, no? Now, if I give you interest amount, if I give you interest rate, can't we find out debenture ka value? How do you find debenture ka value here? Interest amount divided by interest. Yes, Ajay. Sometimes in some problem, debenture ka value will not be given. So, we can find that using interest amount divided by interest rate. Now, check this. We have done this in the question. I think this example should be good enough. We can cut that question. Let us say, sir, do you think we are the only company who will issue debentures, or our competitor also will issue? Our competitor can also issue debentures. Our competitors on their debenture, how much interest they are giving? 12%, I'm assuming. Competitor company on their debentures, on an average, they are issuing how much interest? 12%. But I am issuing the debenture at what rate? 9%. Our company or my company is issuing debentures with what interest rate? 9%. Sometimes we can call it as interest rate, or we can also call it as coupon rate, one and the same. Now, you tell me, as an investor, you will prefer my company ka debenture or my competitor ka? Competitor, because They are giving higher interest. So everybody will invest there. Will anybody give me or invest in my company, or they will not? They will not, because I am giving market interest rate or lesser. Correct, Aji? But I also want people to invest in my company. How do I do this? Tell me what I have to do. Let's say the face value of the debenture is 100. Face value of the debenture is 100. Now you tell me, will I issue the debenture at face value or lesser? Lesser. Because debenture holders, investor are expecting how much return? 12%. But I am giving only how much return? 9%. Now if I issue the debenture at face value, nobody will buy the debentures. So if this scenario, if this adjustment comes in the problem, what is the trick? Or what is the hidden adjustment? I cannot issue the debenture at face value. I'll have to issue it at discount. Tell me, how much is the debenture value? How much is the debenture value? How do you find out debenture value? Just now we discussed. Interest amount divided by interest rate. Interest is always calculated on the face value. What is the face value? 100. Am I giving the actual interest rate at 12% or 9%? So what is the actual interest amount I am giving to the debenture holder? 100 ka 9%. How much is that? 9 rupees. Yes, sir. Divided by interest rate. Interest rate we have to take, or expected interest rate? Expected. How much are they expecting? How much are the debenture holder expecting? 12%. Divided by 12% you do. The expected interest rate. How much are you getting? 9 divided by 0.12 if you do, you will get 75. That means face value of the debenture may be 100, but I cannot issue it at 100. I have to issue it at 75. So 75 becomes your issue price. If you want, you can do the math also. How much is the investor giving me money? How much money investor gave? 75%. Maybe here. Investor is giving me the money of 75%. On how much ever investor invest, how much return investor will expect? 12%. Correct? No. So 75 ka 12% you do. How much is that? 9 rupee. And how much am I paying to them? 9 rupee. Matched out. Yes or no? So that way investor also happy. I am also happy. Because they got their 12% return and I got the investors to invest in my company. This is the drama. Okay now people, when will you apply this? Tell me once again, which scenario will you apply this? When they give you two interest rate. What interest rate? One is the actual interest rate, another one is the market interest rate. If my actual interest rate is lesser than market interest rate, then the only way I can convince the debenture holders to invest in my company is to issue the debentures at discount. And what is a simple formula to get this? Actual interest amount. Numerator may you will take actual interest amount divided by actual interest rate or expected interest rate. Expected interest rate. That's your formula. That will give you the issue price. So in these sort of problem, issue price will not be given. We need to find out. This is simple. No? We'll take care of this. No? We have done 2 questions on this in regular class. But now again, we'll not have time to go through all the problems. So small adjustment I'm discussing with the help of this example. Okay. Need a minute or okay? Yes, sir. What is the 75? Again, walk me through. Issue price. Is this net proceeds? Is this net proceeds? No. How do you get net proceeds? Issue price minus flotation cost. So do not forget flotation cost. Suppose flotation cost is 5 rupees. Issue price how much? 75. If flotation cost is 5 rupees, then the net proceeds will be 70. Take this number and then apply, use approximation method or IRR method or whatever the question says. This is one small specific question specific adjustment. One more shortcut method was there. What is the shortcut method? Sir, if what is the approximation method ka redeemable debt ka formula, you tell me? Cost of debt ka. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. Correct, Aji? That's a normal way. You can find the cost of debt using that formula, or you can go for one more shortcut. You will go for shortcut when RV and NP are same. When the RV and NP are same. If you want, just tell. All of you solve this for me. Let's say the face value of the debenture is 100. Face value how much? 100. What is the actual interest rate company is paying? 10%. So what is the interest amount? 10 rupees. Tax rate, let's say, is 30%. RV, NP, both I've assumed it to be how much? 100. And N is 5. Plug this number and work out cost of debt for me. I here is interest. In this formula, I is interest rate or interest amount. In this formula, I stands for interest amount. How much is the interest amount? 10. So if you want maybe interest of time, I'll only check here. 10 rupees into 1 minus tax rate. Tax rate is how much? 30%. 30% in full number will become 0.3. Plus RV. How much is RV? 100. Minus NP. How much is NP? 100. Divided by N. N is how much? 5. Whole thing divided by what? RV plus NP divided by 2. When you do it, what are you getting? 0.7 or 7%. Everybody okay now? This is the number your calculator is showing. Now you don't have to do all this drama in this case. When RV, NP both are same, you can get cost of debt simply by taking I into 1 minus tax rate. Interest into 1 minus tax rate. I here no is not interest amount. When you're using this shortcut method, I is not interest amount. I is the interest rate. What is the interest rate? 10%. Take your calculator. 10% into 1 minus tax rate you do. Tax rate is 0.3. 10% into 1 minus tax rate you do. How much are you getting? 10 into 1 minus 0.3. What are you getting? 7%? Yes, no. That means whether you use approximation method or whether you use shortcut method, answer is same. Tell me which is faster. Shortcut. When will you go for shortcut again? Once again, tell me. Every formula mein shortcut will work. No. Shortcut will work only when RV NP is same. Or if they have not given RV NP ka data. If RV NP ka data is not given, means RV NP will be assumed to be same. So in those cases, instead of applying this formula, you can use one more shortcut formula. What is that one more shortcut formula, people? I into 1 minus tax rate. I here is not interest amount. I in the shortcut method is interest rate. That's all. This also we have applied. Especially when they give you bank loan and all. Bank loan. On bank loan and all, will you redeem more? If you take principal loan of 10 lakh, how much principal you will repay? 10 lakh only. That means for a bank loan and all, RV, NP, everything will be same. So you don't have to use this formula. You can directly go for shortcut formula. Done, Aji? So this was your overall concept of cost of capital. Can we have one quick 2 minutes ka full recap and then take up some questions? Chapter name, or 1 second, I think everything done. Yeah, all problems done. Chapter name, cost of capital. Capital here refers to share capital. No, capital here refers to, you want me to show the screen? Okay, 1 minute. Oh, I'll show you also. Capital here refers to long-term source of finance. Every long-term source of finance will have a cost, and that cost only we are trying to find here. Done? That is one. And now, first instrument ka cost, that is cost of debt. Debt here refers to debenture as well as bank loan. Now first, in order to find out cost of debt, we need to check whether it is irredeemable or redeemable. If it is irredeemable, cost of debt denoted by the symbol KD is given by the formula interest amount into 1 minus tax rate divided by net proceeds. Net proceeds, first priority for net proceeds will be what? That depends on whether it is existing or new. If it's a new debt, first priority for issue price, IP missing, market value also missing, face value. If it's an existing debt, first priority, market price, market value, MV missing, face value. Doesn't matter what you take, flotation cost you need to minus. Then only you will get net proceeds. If it is a redeemable debt, then cost of debt is given by the formula interest amount into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. In this formula, I stands for what? Interest amount. T for tax rate. RV for redemption value. NP for net proceeds. N for N is not total life. N is your remaining life in this problem. Somewhere I must have written somewhere. Okay. N is for remaining life. Keep that in mind. Okay. Suppose 10 years is the term of the debenture. 10 years is the term. 3 years is already over. 3 years is already over. N is 10 na, or N is 10 minus 3, 7 na. N is always remaining life, not total life. Keep that in mind. Okay. These two formulas, we call it as what, people? Approximation method. There is another way to find cost of debt, that is your IRR method. In IRR method, we use interpolation formula. What is interpolation formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Keep in mind, at higher rate, usually NPV will be negative and you are already minusing it. Negative of negative will become positive. That you want, again, keep in mind. And any rate you can assume, yeah, your choice. But ideally, ICI assumes one rate where you get NPV negative and one rate where you get NPV positive. That's how ICI solves. If you want, you can follow the same, or using any, your choice, you can do it. Now, this is about your IRR. And walk me through IRR ka table format. Year, cash flow, discount factor, present value of cash flows, second discount factor, second present value. Year may you will start with year 0. Then suppose it's a 5-year debenture. Will interest for all the year differ or same? That means you can write in year column 1 to 5 and again 5. What is this 1 to 5 for? 1 to 5 is for interest. You will take interest or after tax interest. After tax interest. In 5th year you will take redemption value. At year 0 you will take net proceeds. Net proceeds will be negative because you are putting this positive negative sign. Though company is calculating IRR. IRR is a return. Why we put the sign from investor perspective is IRR ka full form is internal rate of return. For a company it's a return or an investor. Hence positive negative sign we put it from whose perspective? Investor perspective. So first year 0 may you will take net proceeds as a negative number. Then you will take interest or after tax interest. After tax interest. Last year may you will take redemption value. Plug and do it. Okay, next they went for convertible debentures. In convertible debentures, first you will ask one question. What is that? Whether it is compulsorily convertible or optionally convertible. If it's compulsorily convertible debentures, then you will only take the redemption value of the share option. If it is optionally convertible debentures, then you will take redemption value of cash option, redemption value of share option, whichever is higher. Rest everything is same, no change there. Plug this number into approximate formula or IRR formula and continue. Next we went for preference shares. How do you find preference shares ka formula? Same. First ask whether it is redeemable or irredeemable. If it is irredeemable, on preference dividend you will get tax benefit or no tax benefit. Substitute interest with preference dividend. Wherever 1 minus tax rate is there, keep it or cut it off. So irredeemable debenture, irredeemable preference shares ka formula is preference dividend divided by net proceeds. Redeemable means preference dividend plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. These two becomes your approximate formula. Or you can also use IRR. If you are using IRR, at year 0 you will take net proceeds, negative. Then suppose the term of the preference shares is 10 years. And in the column you will write 1 to 10. You will take after tax preference dividend or preference dividend only. Only preference dividend you will take. 10th year you will take redemption value and use the interpolation formula. Next is cost of equity shares. Dividend price approach ka cost of equity is given by dividend divided by price. This method assumes dividend to be constant. Then earnings price approach. In earnings price approach mein formula is EPS divided by MPS. This method assumes EPS is constant. Then Gordon Chacha. Gordon Chacha ka formula is D naught into 1 plus growth rate divided by P naught minus flotation cost. Whole thing added by growth rate. Or if they have given D1, formula will be D1 divided by P naught minus flotation cost. Whole thing added by growth rate. D naught is dividend already declared or dividend already paid. D1 means expected dividend. G for growth rate. One way to find out growth rate is trial and error. Or another way, B multiplied by R. B is your retention ratio. R for your rate of return on your investment. Okay. Next, CAPM model. In cost of equity as per CAPM model will be RF. RF as in risk-free rate of return plus beta into RM minus RF. RM is your market return. RM minus RF is what we refer to as risk premium. If it is directly given, take that. Then realized yield approach. Realized yield approach is nothing but IRR. But blindly don't go for IRR. Ask one question. What is that question? Year-wise return, can we find out or we cannot find out? If year-wise return you can find out, then find out each year ka. Usually you'll be able to find 4 years ka return. First year ka return denoted by what symbol? 1 plus Y1 given by the formula D1 plus P1 by P0. Second year ka return denoted by the symbol 1 plus Y2 given by the formula D2 plus P2 divided by P1. Third year ka denoted by symbol 1 plus Y3 given by D3 plus P3 by P2. Fourth year ka denoted by symbol 1 plus Y4 given by D4 plus P4 by P3. Multiply all the 4 year ka return and find out which route. Fourth route. Why fourth route? You are able to find out the return 4 years and minus 1 you do. You will get the cost of equity. If year wise return, if you cannot find, then you will go for normal IRR method here. Okay. Then cost of retained earnings. Cost of retained earnings and cost of equity are same, except you will not use flotation cost. Rest all the formulas same. And one more way, from cost of equity, can we find cost of retained earnings? Yeah, one formula is there. KR is equal to cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Last thing is overall cost of capital, denoted by the symbol KO, also known as weighted average cost of capital. For the weighted average cost of capital is simple average or weighted average. And how do you find out this weighted average? First source of finance, take basically that instrument ka weight multiplied by that instrument ka cost. Yes, sir. In fact, if you are for your cost of overall cost of capital, you can construct one shortcut formula also, which you have used in system is doing weird. Where it went? One more formula you can write. Anybody remembers? We have used another way. Overall cost of capital is given by the take cost of debt multiplied by weight of debt, plus if you have equity, then take cost of equity multiplied by the weight of equity. Either you can solve using table method, or you can do it one-liner using this formula also. We have used this in chapter number 5, capital structure problems, if you remember. Both are acceptable. Whichever way you're comfortable, you can use it. Basically, take that instrument ka cost, multiply by that instrument ka weight. Take that instrument ka same. I've just written 2. You should have only 2, or you can have multiple source. If you have retained earnings, or if you have preference shares also, what you will do? If you have preference shares in this formula, then you will take cost of preference shares multiplied by weight of preference share. How many ever source of finance is there, add it up and do it in this particular formula. And what is the first priority to find out weights? Book value or market value? Market. If the question is silent, always pick market value. If the question says use book value, then only use book value. Okay. All right. Then last is your MCC. MCC is, it is same KO only, but for additional funds raised. Only for additional source of finance, if you find KO, we call it as marginal cost of capital. Nice ringtone. All right. Then people, can you find out debenture value? Yeah, you can find debenture value using a particular formula, shortcut way. What is that? In actual interest amount divided by actual interest rate or expected interest rate. Expected interest rate. Keep this in mind. This becomes especially important when market interest rate and actual interest rate will match or mismatch. See, I am paying 9, but market is paying 12. So in these cases, debentures will not be issued at face value. It will be issued at discount. That will be the hidden adjustment on this. And one more shortcut way to find out cost of debt. How is that? If RVNP, if it is same, if RVNP and all is same, either you can use a normal approximation formula, or you can go for a shortcut. What is shortcut formula? Interest rate into 1 minus tax rate. This is for cost of debt. Similarly, what is a shortcut way for preference shares? On preference shares, will you get tax benefit? That means cut off tax benefit. What remains? Interest, dividend rate. The dividend rate only will become KP when you're using shortcut method. And when will you go for shortcut method for KP? RV, NPR, same. Done. This was your conceptual revision. Now can we go for, I think we do have some time. Can we go for a few questions? Okay. Let's take up question number 21. I'll take up those questions, people, and those of you, if you have already watched previous marathon, right? This one again you don't have to watch. Okay, more or less it will be same. Some questions I'll keep replacing it. That's all. But conceptual explanation will be pretty much same. So no need to watch both and all. So that much Kripa Kataksha you don't have to show it on me. One is good enough. Don't waste your time by watching unnecessary things. So, now people, this question also off late. This question is repeated multiple times. So we'll go for question number 21. My voice is audible, na, in the back there. We are used to speaking on mic. Now we are not using mic, but still balcony okay, no? That side, this side. All good. Done, people. I would love to know your name, but I'm a little time pressed. So somewhere during the break, we'll catch up and try to get to know you. Okay? All right. Now calculate WACC, KO by using what? Book value and market value weights. Both we need to find. So that way, good revision question. We can summarize both. Debenture, rupees 100 per debenture. 100 per debenture andre face value. What is the total face value? 5 lakh. What is the face value of one debenture? 100. Similarly, each preference shares ka face value? 100. Total face value? 5 lakh. Each equity share ka face value 10 and total face value is 10 lakh. That means we have one source of finance here or 3? 3. Put together totally how much? 20 lakh. Just keep your calculator. No need to write down anything. These are our study material questions. You will find this in many RTPs and MTPs also. Market price of the share is also given. Obviously, they asked us to find out using book value and market value. Now, 1 second, people. They said capital structure of the company is as follows. Capital structure means this capital company is planning to raise or already raised. This capital or this source of finance company has already issued. I mean, this is a value as per what? This is a value as per accounts. That only we call it as what? Book value. So this value is nothing but your book value. So using this, you will be able to answer the first requirement. But they also need to find out what? Market value. For that, they have given it over here. Once again, everyone tell me over here. How much is the total face value of the debenture? 5 lakh. Each ka face value how much? 100. That means how many debentures we have, people here? 5 lakh divided by 100 if you do, you will get how much? 5,000. Yes, no? 5,000 is the number of debentures. Do you agree with me? Or maybe can I write it like this? Number. How many number of debentures we have? 5 lakh divided by 100. How much is that, people? 5,000. Similarly, 5 lakh divided by 100. How much is that? 5,000. 10 lakh divided by 10. 1 lakh. So these are the instruments we have. Do you know market value of each debentures, preference shares and equity share? Yeah. You take market value of each and multiply by the number of instrument. What are you going to get? Total market value. That way you will find out market value also, which will help you to sort out the second requirement. Done. Now additional information is given. 100 per debenture, the face value are redeemable at par. Redeemable at par means RV I got how much? 100. Par value means face value, which is 100. Then they said what? 10% coupon rate. Coupon rate means interest rate. On this debenture, we are paying 10% interest rate. Flotation cost is 4%. Don't forget that. 10-year maturity. So 10 becomes your N. Sir, the moment they give you RV, it is irredeemable debentures or redeemable? In fact, they've given maturity period also. N also they've given. So this is a redeemable debentures. So which formula you will use? Redeemable. Don't blindly start. Here ICA will put a bomb. At the end, they will say, see, use YTM method for cost of debt. We have seen many students like this. They'll see the data, they'll be like, nice, start solving. Right? They'll always know, people, when the question is big. In fact, it's a good practice. Always quickly know the requirement. You don't have to spend too much time. Just quickly read. They're asking use YTM. YTM method means yield to maturity, or IRR method for what? KD and KP. But for equity shares, they have not told. We'll see that. So can we use that formula or IRR? IRR. IRR is your favorite. Yeah. All right. Now, people, if you want, there's an option. Not required and not compulsorily required in exam. Now, some students will have the buku. The fear of what rate to assume, sir. In class, we assume the rate, so it is easy for you. Aram se you will copy. But in exam, when they directly ask IRR, our hands our mind will be like 5, 7, okay, 10. What rate do I assume? Can become a little bit of problem. So if you are in that category, I'm not saying everybody will be in that, but if you come to that category, you don't have to tell anybody, right now. So if you are in that category, what you can do for yourself is first solve using approximation method. No need to quick solve, just do it in your calculator. Now do it in calculator for me, just let's see. Or here only quickly I will solve. What is that number? Tell me. What is the formula, people? Tell me here. Interest into 1 minus tax rate plus RV minus, it's coming out. 1 second. I'll have to pull this in. Interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. How much is interest amount here? Interest is calculated on what? Face value. What is the face value of the debenture? 100. What is the actual interest rate? 10%. How much is the interest amount? 10. So interest amount is 10 rupee. 10 into 1 minus tax rate. What is the tax rate, people? Somewhere we saw tax rate, no? Where is tax rate? Here, tax rate is 30%. So 10 is your interest. 10 into 1 minus tax rate if you do. So 7. So you got 7. Plus RV. How much is RV? 100. Minus NP. Minus NP. NP, be a little careful. New debentures. New debentures. Okay. Sometimes, know what, people, you'll not be able to figure out whether it is new debenture or existing. In that case, if that's category, first check if issue price is given. If issue price is given, issue price given, issue price, they told redemption price. Have they given issue price? No. If IP is missing, next priority for market. Okay, how much is market value? 10. Can market value become net proceeds, or you have to reduce flotation cost? Reduce flotation cost. So 105 minus 4% you do. How much is that? 105 minus 4%. How much is that? 100.8. Got it. Or maybe I've solved it here. I'll quickly show. Where is it? Here. You're getting the same number. NP is 100.8. Correct? RV is how much? 100. Divided by N. What was N here? 10. 10 years is a life. Whole thing divided by RV plus NP divided by 2. So when you solve, we are getting 6.89 roughly. Correct? Sir, whether you go for approximation method, this or IRR method, answer will not be same, but answer will be close. Answer will be close. That means in formula method, what are you getting answer? 6. 6.89 something you're getting, subject to decimal. So what I will do is take one number below this, take one number higher than this. 6 minus 5 is how much? 5 plus 1%. So what is it? 7. That means what rate I'm going to assume? 5 and 7. That way you can do. Is this compulsory or your choice? Your choice. You can directly start with 8 or 10 or 12, whatever. If you don't get that hard to proceed, then first solve like this. Should you have to write each step or calculator? Quickly calculator mein calculator. That way you will get the answer. And now you can figure out one rate below this is 5. One rate above is 7. Take 5 and 7 and solve the question. That is another way. Done now. Okay, walk me through IRR ka process. Cost of debt. You'll start with column you already know. Year, cash flow, discount factor, present value of cash flow. First discount factor I'm assuming 5. Second discount factor 7. Year column you will start with year 0. Year 0 always net proceeds. Always net proceeds. How do you get net proceeds? Here IP is missing. So you took market value. Market value or market value minus flotation cost. Market value was 105. When you reduce flotation cost, you got 100.8. So year 0 you will start 100.8. Positive, negative. Negative. What's the term of this debentures? 10 years. Every year interest changing or same? So should you solve it 10 times or shortcut? Shortcut means PVIF or PVAF. In the year column, what you will write? 1 to 10. Cash flow column, you will take interest or after tax interest? After tax interest. How do you take after tax interest? Interest amount, which is 10 rupee, into 1 minus tax rate. How 10 rupees? Interest is calculated on face value. Face value is 100. Interest rate you're paying is 10%. 100 ka 10% is 10 rupee. Into 1 minus tax rate, if you do, you will get after tax interest. Comfortable? 10th year, you have to take one more. What is the one more you have to take? RV. RV as in redemption value. They told in this problem it's redeemed at par. So par value is how much? 100. Yes, Aji. Solve and at 5% when you solve, you are getting 14.63. But we want what? If 14%, if 5% is the right answer, my NPV should have become 0. So is 5% my IRR or cost of debt, or take one more rate? Take one more rate at 7%. At 7% we are getting negative. So IRR is somewhere between 5 to 7. Plug in the interpolation formula. Should I have to take you through this again or okay? This is comfortable. Now? So you got finally what answer? 6.8. That is one way. Done now. No issues. And now same way for preference shares. Even preference shares we'll have to solve under IRR method. If you want first, what you can do? First solve under approximation method. Compulsory or your choice. Why are we doing this for? To find out the discount factor. It's completely your choice. When you solve same thing, now KP first under approximation method. What is approximation method ka formula? Preference dividend. First of all, preference shares, was it irredeemable or redeemable? I think we didn't read that data. No? So here check. And maybe one more point. A student will ask, sir, they have given 4%. This flotation cost is a number or percentage? This percentage, should we apply it on face value, which is 100, or issue price? This 4% flotation cost, should we apply it on face value or issue price? Depends on the question. Sometimes the question will say apply flotation cost on face value. In that case, you will apply it on face value. If they have not told anything, always calculate flotation cost on the issue price. Issue price or market value, whichever you are taking. Okay, that only you calculate. Done, Naji. But usually question will mention that. Okay. Next to preference shares ka data. 100 rupees is the preference shares ka face value. They are redeemable again at par. That means redemption value is 100. You got that. Coupon rate. Coupon rate here for preference shares, it is interest rate or dividend rate? Dividend rate. 2% flotation cost. 10-year maturity. Sir, have they told to calculate flotation cost on face value? No. So you will apply what? Market price or issue price depending on what you are taking. Now you tell me, for this preference shares, issue price given a missing. Missing. Have they told this preference shares are issued at 110 blah blah? No. If IP is missing, you will give next priority for what? Market value. What is the market value? 110. So you will calculate flotation cost of 2% on 110. Done now. And now check, I've just solved it for you here. Preference dividend. Preference dividend, interest and equity dividend. Everything calculated on face value. 100 rupees is a face value. Dividend rate is 5%. So preference dividend becomes 5. Plus RV. RV you already know. How much is that? It is redeemed at par. Par value is 100. Minus NP. How do you get NP, people? How do you get NP here? Walk me through. Issue price minus flotation cost. Right? But IP is there? No. So what we took? Market value. So here NP will be market value minus flotation cost. What was the market value given to you in the problem? 110. Minus flotation cost. Flotation cost we will calculate on market value itself. So when you calculate, you will get 107.8. N is your remaining life. Have they told anything specifically about remaining life? No. Hence we will take the data given. How much is the data for N they have given? 10 years. So plug this into the formula, you will get 4.06. Now you tell me, for IRR method, what rate will you assume? One rate below, which is what? 3. One rate above, which is what? 5. So that means for IRR method to find KP, we'll take 3% and 5%. Done now? Just walk me through the year columns. We will start with year 0. Year 0, what you will take? Net proceeds. Then, what is the term of this preference shares? 10 years. You'll take 1, 2, 3, 4, 5, 6, 7, 8 or 1 to 10. Here you will take after tax preference dividend or only preference dividend? Only preference dividend. 10th year you will have to take the redemption value. Okay, Naji. Remember, net proceeds in negative, redemption value and preference dividend in positive. Because we are you're putting the positive negative sign from investor's viewpoint. Solve and you'll get the answer. Easy na, sir? This is also pretty comfortable. This is about your KP. This is okay. No, we don't have to go through each step, right? Just a walkthrough should be fine for us. Revision, right? All right. Now, equity shares. So, flotation cost given in percentage or directly the value? Flotation cost itself is 4 rupees given. Market price is how much? 24. Next year expected dividend. Dividend paid ala. Expected dividend means D0 or D1? D1. Growth rate they have given. Now, there is only one formula in equity shares which uses growth rate. That is our Gordon Chacha. So, that means we have to find cost of equity using Gordon Chacha ka formula. Done now. We'll use D0 ka formula or D1 ka formula. D1 ka, because they have given D expected dividend in this formula. And growth rate we have to find or given only. Tell me again once again formula. What is cost of equity as per Gordon Chacha? D1 divided by P0 minus flotation cost. Whole thing added by growth rate. Do it quickly in a calculator. D1 is 1 or maybe why to do it. I'll show it over here. D1 expected dividend. How much is that per people? 1 divided by P0. Sir, P0 you will take what as first priority? Issue. If you are not able to find out whether it is new instrument or existing instrument, first priority you will give still for IP. IP missing means market value. That is also missing means face value. Your IP given for equity shares. So you will use what? Market value. What is market value of equity shares? 24. So that becomes your P0. Minus flotation cost. How much is flotation cost? 4 rupees. Whole thing added by the growth rate. If you do it, 10% is your answer. Done now. Alright. Now people, to calculate KO, we need all the instrument ka respective cost and all the instrument ka respective weights. So now simply plug this into the formula and get it. Using book value if you're finding KO. What is the book value, people? 5 lakh, 5 lakh, 10 lakh. So tell me the weights. Total money raised is 20 lakh. Out of that 20 lakh, from debentures you have got 5 lakh means what is the weightage of debenture? 5 lakh divided by 20 lakh. How much is that? 0.25. Yes, somewhere is it here. That is your weightage for this thing. In fact, people, in exam, is this column really required, or you can start from this? Effectively, we need what? Weights, right? If you want this book value column totally, you can cut off. Or is this table or required, or you can use one line of formula? What is that one line of formula? Weight of debt multiplied by cost of debt plus weight of equity, and that one line of formula also you can use. Or if you're comfortable with the table, do the table. Okay. So weights calculation, understood everybody? And this after tax cost of capital will come from our previous working notes. So take that instrument ka cost, multiply that instrument ka weight, you will get KO. Adding all this, you will get overall cost of capital this much. Done now. One more point is, sir, this cost of capital, if you want, you can take it in decimal or you can take it in percentage. If you take this in percentage, 6.89 percentage, that means final answer will be in percentage. If you take decimal, then final answer will be in percentage, and you'll have to convert it, multiply this by 100 and get it into percentage. I recommend you to use percentage so that you will get the answer faster. But in all our problems, all our class, we have taken the decimals. Because initially stages we were in, so I took all the things in decimal. Now we are in exam stage, so we will probably prefer those methods which will save more time. So which will save a little more time? Percentage. So hence I would recommend you to take directly percentage. So answer will be directly in percentage. Now market value. Just can you help me calculate the market value, people? Just that alone. How do you calculate market value? One quick way to calculate market value is what? Very simple. Total book value of debentures is how much? 5 lakh. What is face value of each debenture? 100. Sir, if you do 5 lakh divided by 100, what are you going to get? 5,000. That is the number of debenture, and each debenture ka market value is given as how much? So multiply, you will get the face value, or you will get the market like this. Yes, Ajay. So how much you are getting? 5 lakh 25,000. Okay. Same thing you calculate for preference shares. We'll check. You will take 5 lakh divided by each instrument ka face value 100 multiplied by the market value of each preference shares, which is 110. How much is that? 5,50,000. Same for equity shares also. 10 lakh divided by face value of each share, which is 10. By doing this, what are we going to get? Number of equity shares multiplied by market value of each equity shares is 24. So if you do 24 lakh, that's all. So how much was that value you said? 5 lakh 25, 550 and 24 lakhs. So total is 34 lakh 75,000. Rest is weights. How do you calculate weights as per market value? Same. Total market value is 34 lakh 35,000. In that 5 lakh 25,000 has come through debenture, means what is the weightage? 5 lakh 25,000 divided by 34 lakh 75,000, which is 0.1510. Done, sir. Sir, another doubt is, sir, how many decimals should I take, sir? ICA, know in their majority of solutions have started to take 3 decimals. So if you want to follow, actually there is no pakka rule that you have to take 4, 3, 2, 1, right? If you want to sync up with ICA, they are taking how many decimal? 3 decimals. So if you want, you can also solve for exam in the same fashion. Even if you take 4, in my view, marks will not be deducted for it. Okay, na? Just for ICA syncing up, if you want, you can take 3. Any problem in this problem, people? Easy, no? Just a walkthrough of this question. Hungry, yeah? Not angry, no? Fine, right? All right. I can do a few more questions. Now, 1 or 2 more we can do and then take a break if required. Of course, break is required. But after 1 or 2 questions is okay. Done. Sir, people, this question also we have seen repeating in exam multiple times. By the way, all of you have, I didn't ask, how many of us are meeting for the first time? First, sorry, I'll rephrase that question. I think meeting for the first time, yeah, since I take classes in Bangalore, we would have not met. How many of you have not attended my class in one form or the other and you're seeing me for the first time? So are we okay, comfortable with the approach, methods and all? That's okay, right? Okay, that's okay, all right. So why I specified is, in fact, if you want, I think balance, I believe others are all have taken classes from me or some way or the other. Remember, we used to give LDR questions. LDR is last day revision. If you want, for those newcomers, you can share it with them. so that it can help them on the examination day as well. If you want, you can collect. I don't have the list with me, otherwise I could have shared it with you. Okay, so these are all coming under the LDR list. Okay, yeah, and by the way, how many of you are writing both the groups? Remaining all group 2 or group 1 is already over. Already cleared. Now group 2 is pending. How's your prep going? When don't ask this question, sir. Rest everything is okay. You chumma do your work. Don't ask this preparation and all. Our heartbeat will increase a little. Yeah. When is the group 2 starting, by the way? 11th. Oh, yeah. Exam got pushed a little bit, right? But still, group 2 may not much impact, no? 2 days it got pushed. Okay. So, which is your in group 2? I think what costing FM is practical paper. Auditing SM is Daivame paper. Yeah. All right. You're comfortable, huh? Overall, what do you think your strong subject is in group 2? Costing, okay. FM is also okay. Mostly costing. Auditing, no. I thought someone will say auditing. Auditing, nobody. No, not even single takers. Why? Karthik sir on that side is laughing. I put in my heart to blood. They're not choosing my subject only. Yeah, but I do understand. Auditing is too much of theory, too much technical. You need to remember, I think. Yeah, but people don't ignore or don't do that favoritism. That yeah, costing FM properly I will study, and auditing I will just prepare that much where I get 40. Don't do that, because in practical paper, no, there is always a scope to, they can manipulate the question just by changing one data or bringing in one new adjustment. They can kind of spoil your whole day, whole mood, whole exam, whole group ka exam. A lot of things can happen, right? Especially with practical paper. With theory paper, you don't see that with too many questions, right? Yes, remembering theory is tough. Studying theory is even more tougher. Okay, the moment we start, we'll be like, yeah, that wala feeling. I do know that. Yes, about 14 years. I mean, yeah, but back I was also sitting on the other side, so I get that feeling, right? So, but still, yeah, she came at the exact same time. She was studying auditing only, so she said for 2 hours. Yes, no, ma? Yeah, said it down. FM marathon only, no. So, but in order for you to crack the group, right, one exemption you should get ideally in some paper. And especially if theory papers cross somewhere 50 range, right? More or less, you could say you're past that group. Because majority of the students find it difficult to clear aggregate because of theory paper. Because then auditing on papers like this, they'll end up scoring 43, 44, sometimes 39. Ouch. That, very difficult to recover. Yeah, too disheartening. We've seen so many people, 154 in aggregate. 38, 39 in one subject. And 58, 59 in another subject. So, exemption also gone. Aggregate also gone. Once again, we have to study. Yeah, that is very difficult to digest. So, don't keep your preparation to that touch and go thing. Try to go one subject a little more. Whichever is your favorite subjects, try to do one extra revision for your favorite subjects so that you try to cross 60, 65. In one paper, I feel if you cross 60, 65, more or less aggregate will be cleared. Okay. So focus on this, and theory also at least revise. Just don't go study, because theory you'll not be able to remember unless you revise it often. So don't ignore the theory blatantly. Okay. Prepare, because theory is a paper which will ultimately make you chartered accountant. Trust me on that. Yeah, it is. Though we like practical subject, theory is the one which actually helps you to clear examination. For many of them, because you need to score 40, 45 there to cross the aggregate. Otherwise, CA will not be chartered accountant. It will be come again for exam, which we don't want to, right? Yeah, but yes, do keep the confidence high. Never let in the last 15, whatever, how many days you have roughly now? 20 days. Never let your confidence come down. I feel CA examination at the end of the day is purely confidence. Preparation backed by confidence. Otherwise, it will become more confidence. Not preparing and say, Pathikla macha, that will not work. You need to prepare once, revise once. If you have done this, convince yourself, I'll be able to do it. Just keep yourself this very, very calm. Let this not beat faster than what it is actually required. Let it beat faster for your girlfriend, boyfriend, not for exam. Okay? Keep this quite calm. I do know that last 20 days in exam can be very, very stressful. Okay? But tell yourself that it is just an exam, not your life. Just one part of your life called exam, and that too, this part will stay with you maybe for another 1 month. Sir, your existence is 70, 80 years. Yes, no, 7 less. She's saying 150 kodo. Okay, 150 for you, ma. All right. So in 150 years of your existence, 1 or 2 months you are spending for exam. If you say classes, preparation, everything put together, that is hardly 2 years. Whole CA journey. So that is a very insignificant portion. Because of that, you should not become too much anxious, depressed and all that. Not worth it. Nothing in life is worth getting depressed for. Life is a celebration. We should celebrate. Right now, it's a journey. We are celebrating this with the help of studies. Just aram se, enjoy fully. That's what I would say. If you're studying, be so involved with studies that you should say, wow, what a person. You should give that flying kiss to yourself. Because I'm so happy that I've prepared well. When you're doing like that, right? And once the exam is over, go to the road and dance, I say. Yeah. Right? And then we celebrate like our Talaiva movie, no? Talaiva Talapati movie. Like that, you should celebrate your result. Put out a cutout for yourself, pour milk. That's. I mean, if you do that, let me know. I'll also come. I'll also pour a little milk for you. Yeah. So I'm just saying, give yourself 100% in any direction. Whatever you're doing, give yourself 100% involved so that later you don't have that regret. Because after exam, I see so many students telling, I should have studied 15 days more. Just 1 month more. So let us not have that regret life. Life, I feel, should not be lived on a regret terms. Full in. Live life in such a way that chairman should be proud. I say chairman, wow, Macha, what an amazing person you are. Take that. You'll be like, yeah, thanks, Macha, and move on. Right? That way. Yes, can we come back to the, can we come back to the question? Question number 22. This question is also repeated a few times in exam. Let's see what we can learn from this question. This question is on MCC. MCC as in marginal cost of capital. ABC has the following capital structure, which is considered optimum. Optimum means ideal. Optimum means ideal, perfect, you could say, like you wonderful people, this capital is perfect. That means you tell me, if it's a perfect capital structure, then the weights are also perfect. Weights are also perfect. Would you like to change that perfect weights or not change? Not change. First, find out the weight. What is the, we have one source or three source? What are the three source? Debenture, preference shares, equity shares. Debenture, how much money? 30. Preference shares, 10. Equity, 160. Total, 2 lakh. First, tell me what is the weightage. Out of 2 lakh, 30 has come through debentures. What is the weightage? 30,000 divided by 2 lakh. How much people? 0.50, no? 0.15. Similarly, calculate. Out of 2 lakh, 10,000 has come through preference shares. So, weightage is 0.10. So, balance will be from equity. 1,60,000 divided by 2 lakh. How much, Saru? This second one is 0.05. Huh? Okay, second one is 0.05. And equity is 0.8. So, total of weight should always be 1. Okay, na? If you are getting any, sometimes when you get in decimals, right? Adjust the decimal in the last. Total of weight should always be 1. Right? If you are taking, let's say, 4 or 5 decimals over here, then try to adjust the decimal round off error in the last one. Anywhere you can adjust, but in class we used to do it in the last one. Okay, na sir? Now this weightage they are saying is optimal. That means will this be changed or maintained? Maintained. Keep that point in mind. Company share has a market price how much? 23 point share. So when they say share, it is always equity share. If they don't mention whether it is preference shares or equity shares, it is always equity shares. Because usually preference shares are not traded in the stock exchange. Which shares are traded? Equity shares. So here it's a equity shares ka market price. Next year dividend. Next year dividend means D0 or D1. Dividend already declared or dividend already paid, we call it as D0. This is dividend paid or next year dividend. Next year dividend. So D1. Given or directly or some percentage. It is 50% of 2017 ka EPS. Now check the next slide. They've given. This is the EPS data they've given. From 2008 till 2017. Many years ka EPS they've given. How much is EPS for 2017 that they said? 2.36. So what will be D1? What will be D1? D1 will be 2 point, how much is that? 2.36 ka 50%. How much is it, Guru? 1.18 is your D1. Any problem? No. Okay, next. The following trend in EPS they have given for 10 years. Sir, why did they give you EPS ka trend? Basically, they have given 10 years ka EPS. Why? Growth rate. Now check. 2018 May it was 1. 2008 May it was 1. Next year it has become 1.1. I mean, there is no growth rate or there is growth rate? There is. Sir, if there is no growth rate means, if 2000 EPS was 1 means next year also it should have been 1. Then also it should be 1. Is it same or increasing? Increasing. So there is a growth rate. If you want formula for, you can directly do it. I think it's 10%. 1 plus 10, you can do it in trial and error method. 1 plus 5% you do. 1, take 1 and do 5%. How much you get? 1.05. Is it 1.05 or 1.1? So 5% is not growth rate. Test it at 7%. 1 plus 7%. You're getting 1.07. Matching. No, it should match with 1.10. Now you take 1 plus 10%. 1.10. How much you're getting? 1.1. Now again take 1.1 plus 10% if you want. You will get 1.2. This is your trial and error method of finding the growth rate. Fine. And this is one way you can do it. You can simply write growth rate is equal to, in your exam, no, you can write growth rate is equal to 10%. Trial and error. That's it. That's good enough. Or you can use formula also. Remember one formula we used to use to find what is that? Trend they have given. No, it's nothing but increase in amount divided by original amount into 100. Any 2 years you take. Don't be a Bruhaspati and take this too. It has to be 2 consecutive years. 2 consecutive years. One has become 1.1. So how much is the increase? From 1 it has become 1.1 means the increase is how much? 0.1. Correct? Divided by original amount. Original amount means previous year ka amount. How much is that? 1. 0.1 divided by 1 into 100 if you do, you will get what? 10%. That way also you can apply and show this as a working note. Your call. Either directly trial and error or this particular way of presentation. Done, Naji? So growth rate we got to how much? 10%. The moment growth rate comes in, cost of equity through Gordon Chacha. And D0 wala formula or D1 wala formula? D1 wala. Company issued new debentures. Company issued new debentures. That means new debentures means first priority market value or issue price. Okay. How much interest rate? 16%. And the current market price is 96. Sir, we have issued new debentures, but at what issue price? What is the issue price? Given specifically? No. But they have said market value is 96. Sir, if market value is 96 means you will issue it at what price? Market value only. Yes, no. So that means in this problem, IP and market price both are same. How much is that? 96. Or you can use other logic also. IP is missing means next priority, market value. How much is that? 96. Done now. Sir, we read the debenture. Are we given a redemption value given a? No. N given a? N is given a? No. N is missing means it is redeemable or irredeemable? Irredeemable. Irredeemable ka very easy. But straight away we will start or read once the requirement. You need to calculate cost of debt. Anywhere they mention YTM method. No, that means we'll use what? Formula method. What is the formula method for cost of debt? Irredeemable ka. Interest into 1 minus tax rate divided by net proceeds. What is net proceeds here? 96. Or flotation cost? Not given. Flotation cost? Not given. Market value 96. Flotation cost not given. So calculate how much will be the cost of new debt over here. Here, interest, this is the formula. Interest into 1 minus tax rate divided by net proceeds. Interest at 16%. What is the face value of the debenture? What is the face value of the debenture? Given now when face value is not given, it's very easy. They have given market price. How much is market price? 96. So face value will either be, confusion is whether to take face value 10 or 100. 10 or 100. This 96 is closer to 10 or 100. 100. This whatever data they have given, check that number is close to 10 or that number is close to 100. This 96 is close to 100. So face value here will be how much? 100. What is the interest rate? 16%. Interest always calculated on face value. So how much is the interest amount? 100 ka 16%, which is 16. 16 into is the interest amount into 1 minus tax rate divided by net proceeds. Here net proceeds, what are we taking? Market value. You do it, you will get cost of debt to be 8.33%. Easy now. Very straightforward one. Next to they are asking us to find out what? Preference shares 9.2 with an annual dividend of 1.1 were also issued. So preference shares are issued at what price? 9.2. Correct? That means here issue price is missing or given? Given. Any flotation cost is there? No. N given for preference shares. N given or missing? If N is missing, it is redeemable or irredeemable? Irredeemable preference shares ka formula. Chapandi. Preference dividend into 1 minus tax rate or only preference dividend? Only preference dividend. How much? 1.1 divided by net proceeds. 9.2. 1.1 divided by 9.2. How much is the answer? Preference shares, I have got 1.1195 or 11.95%. Correct? 11.95% is your KP. Done, Sarji. Next, what is the second requirement? So far, good, no, all of us? No issues. Okay, next, what did they ask? You need to find out, first requirement is you need to find after tax basis cost of new equity shares, assuming new equity is from retained earnings. That means, are we issuing new equity shares or taking retained earnings only? That means, effectively, they are asking what, sir? KR. KR. Since they gave growth rate, which formula? Gordon Chacha. Flotation cost will consider or ignore? Anyway, flotation cost is not given in this problem. Even if they had given, we would have ignored. So, what is the formula? And they have given D0 or D1? D1 we already found out. How much is that? 1.18 divided by P0. How much is P0? Sir, retained earnings we cannot issue. So, first priority for retained earnings ideally should be market price. How much is that? 23.60. So, calculate Gordon Chachaka formula. D1 that is 1.18 divided by P0 which is 23.60. Whole thing added by growth rate 10%. 1.18 divided by 23.60 plus 0.1 if you do, you will get the decimal answer. What is the decimal answer? 0.15 or 15%. Okay, Naji. This is your cost of retained earnings as per your Gordon search model. First requirement done. This is very, very faltu. Next, what are they asking? They are asking you to calculate marginal cost of capital when no new shares are issued. So that means now you tell me company is issuing what and all? New debentures, new preference shares and retained. So for these three you are finding the KO. These three you are finding the KO. So we are finding KO for total or only the new instrument. Hence they are calling it as what? Marginal cost. Sir, whether you call it as marginal cost of capital or whether you call it as weighted average cost of capital, calculation is any which way? Same. Done now. So for calculating KO or marginal cost of capital, we need two instruments. What is that? Or we need two things. What are those? Weight of that instrument, cost of that instrument. Yes. Sir, we already know the weight. They told in the previously only, this is the optimum capital structure. That means, will this weightage be changed? No, even after new instruments are issued, the weights will be same. Because this weights will never be changed. Agreed, everybody? Just to tell you once again, suppose company needs 1 lakh money. Suppose company needs 1 lakh money. How will they raise that 1 lakh, people tell me? Entire money will come through debenture. No. Because this weights will be disturbed or not disturbed. So if company needs 1 lakh money, 15% or 0.5 or 1 lakh, how much is that? 15,000 will come through new debentures. 0.5 or 5%. 5% of 1 lakh is how much? 5,000. 5,000 will come through preference shares. Correct? Balance 80%. 1 lakh ka 0.8. How much is that? 80,000 will come through either through retained earnings or new equity shares. Anyway, both belongs to equity shareholders. Correct? So no matter what, whenever you raise money, will this weights be disturbed or it will be maintained? It will be maintained. Because they said in the problem it is considered optimum. Optimum means ideal. So we would not like to disturb that. Done, Sarji. So weights are missing or weights you already know. Here. Weights are missing or weights is this only? Weights are this only. What about cost? Cost just now we found. Cost of, what is that? Here, cost of debt is 8.33 percentage. Cost of preference shares is 11.9. Retained equity na retained earnings are. Retained earnings ka cost is 0.15. Weights anyway we already have it previously. Take that instrument ka weight multiplied by that instrument ka cost, you will get the overall cost of capital. But will we call this as weighted average cost of capital or we'll call it as MCC? Because this is the cost only for the new instrument. This is also pretty easy. No change. And this question is LDR only because of the next adjustment. It's the same study material question. We have done it in class also. Read the next requirement. Determine the amount that can be spent. Determine the amount that can be spent for capital investment before new ordinary shares must be issued, assuming retained earnings for next year's investment is 50% of 2017. Now, one second. I'll tell you what they're asking. What is 2017 ka EPS? 2.16. Take a calculator. How many shares does this company have? Check, they've only given. Company has how many shares? 10,000. Sir, EPS ka full form is what? Earnings per share. Earnings per share. For one share, how much is the earning? 2.36. We have one share of 10,000 shares. So multiply. 10,000 into 2.36. How much da? 10,000 into 2.36. 23,600. That is your total earnings. Any problem? Keep your calculator. So far, okay? Now, people, when a company earns the money, they can do two things. One, retain that earnings or distribute it as dividend. Retain the money or give it as dividend. So here, company is retaining 100% or they said 50%. Retained earnings constitutes 50%. That means how much our company earns, 50% they will give it off as dividend, other 50% they will retain. That's what the question is saying. How much did the company earn here? Total basis 23,600. Fully they will distribute or 50% retention. How much is retained earnings? 23,600 ka 50%, which is 11,800. Any problem? This is your total retained earnings. Any doubt? Anybody in this number? Pakka. Now, people, do you know the weightage of retained earnings? Do you know weightage of retained earnings? How much? We already know. Sir, retained earnings, equity, both are same because both belongs to equity shareholder. Equity and retained earnings put together, how much is the weight? Equity shares and retained earnings put together, how much is the weight? 0.8. Yes, sir. That means, can I say 80% of total money will be from equity and retained earnings? 80% of the total money. Whenever you require total money, 80% of that money will come through retained earnings. See, I'm writing one sentence. See if that makes sense to you over here. Or maybe I'll write it here only. Retained earnings. Retained earnings is 80% of total capital. Do you agree with me? Retained earnings is 80% of total capital. Yes, sir, people. Any problem? Pakka, 100%. How much is retained earnings just now you got? 11,000? 11,800. Sir, 11,800 is your retained earnings and this is what? 80% of, can I say TC? TC means total capital. Therefore, can't you find out TC for me? How much is that? How did you get 11,800 divided by 80%? 80% is 0.8. How much is that? 14,007. Okay, everyone. Pakka numbers are good. And that's what I've calculated here. Check. So, retained earnings is 11,800 and retained earnings constitutes how much percentage of total capital? 80%. How is this 80%? Is this 80% specifically told to us or hidden adjustment? Hidden adjustment. How? What is that hidden adjustment? They said current capital structure is optimum. When we found out current capital structure ka weightage, retained earnings and equity constituted how much? 80%. Hence, we concluded retained earnings equity put together is 80% of total capital. Correct? Therefore, total capital is how much? 14,750. Good. Now, read the requirement once again if you have not understood. Determine the total amount that can be spent before ordinary shares must be sold. Now, people, retained earnings is unlimited source or limited source? Retained earnings is not infinite number. No, it is only limited. In this particular company, or this company rather, how much retained earnings it has? 11,800. Correct? So they are asking up to what level? Up to what level? Sir, whenever company needs money, they will touch one source or three sources. Whenever company needs money, they will raise it from three sources. What are those? New debentures. New debentures to the extent of 15%. New preference shares to the extent of 5%. Retained earnings or equity, one of them, to the extent of 80%. Correct? So whenever company needs money, they will raise in this format only. Got it? Now in the question they are asking, up to what level new equity shares are not required? Up to what level new equity shares are not required? That means what is the source of finance? New debt, new preference shares and retained. Up to what level you can only manage from these sources. And retained earnings is not unlimited supply, it is only limited supply. Correct? No. In this problem, how much was retained earnings? 11,800. 11,800. And retained earnings constitutes how much weight on total capital? 80%. So that means retained earnings is 80% of total capital. Andre, what is that total finance or total capital? 14,750. Correct? Meaning up to 14,750, company can manage only with three sources. What are the three sources? New debt, new preference shares, new equity or retained earnings. If you want cross check, how much is the total capital? 14,750. How much money will come through debt, people? 15%. Take your calculator. I think I've done it over here. Right? If you need 14,750, how much money will come through debt? 15%. How much is that, people? Tell. To 14,750 ka 15% or 0.15. Your call. 2,000 or 2,213, can I say? 5% of the money will come through preference shares. 14,750 ka 5%. How much is that? 730, 737. Correct? Add these two for me. 2,956. Okay, that's it. Or even 80% will come through retained earnings. What is 14,750 ka 80%? 11,800. Is 11,800 retained earnings available? Yeah. That means now you tell me what is the total. Add all this. What are you getting? Add all this three for me. 1 second. If you add all this, you're getting 14,000. That means tell me up to 14,750 is company required to issue new equity shares or not required? That is what they ask. Up to what level we can manage with debt, preference shares and retained earnings. So that's the answer. That's a requirement and I hope we got it. Pakka? Everybody? Suppose the requirement is 15,000. What will happen? Suppose company needs for new project. Let's take this number. 15,750. What will happen? Suppose company wants to do a new project. How much new project will cost? I'm assuming this is just for your reference. It's not asked in exam. I mean, in the requirement. Just for our reference. Suppose company needs a money of 15,750. What will happen? Up to 14,750. Up to 14,750. Company can manage with new debt, new preference shares, new equity or retained earnings. Retained earnings. Correct? But beyond this, what is these two ka difference? What is these two ka difference? 1,000 rupees. Now level there or level crossed? Level crossed. That means for this 1,000 shares, company will have to issue now equity shares. Full law. No. Company wants to maintain an optimum capital structure. In optimum capital structure, 15% money will always come through debt. 5% money will always come through preference shares. 80% of this new money now will come through retained earnings or retained earnings full damar. Retained earnings is exhausted. That means now 80% of the money will come through new equity shares. So up to 14,750 you can manage with these three sources. If it goes beyond that, then the money will come through again three sources. Which are the three sources now? New debt, new preference shares, retained earnings or new equity. In different ratio or same ratio? Same ratio. This they have not asked, just for your reference we have put it across here. Pakka na ji? Okay. And that means if you can express this in formula, what formula you can tell? If you want to find total capital from retained earnings, how will you find? Take the retained earnings divided by the weight of retained earnings. Retained earnings ka amount divided by retained earnings ka weight. That's what I've written in the chart book there previously. Retained earnings amount divided by percentage of retained earnings. Percentage of retained earnings is nothing but retained earnings ka amount. That's what this formula. By this, you can find out the total capital. Okay, na, Sarji? All right. Now, which question was this, pa? Second question, huh? Okay, so this is done now. Third requirement also done now. Now, fourth requirement, check again. No? Compute the MCC. Compute the MCC. I think we already computed MCC here. No? Now, again, they are saying compute MCC when the fund exceeds the amount calculated in C. Sir, as per C requirement, how much can you manage only with the new debt, new preference shares and retained earnings? What was that level? 14,750. Now, last requirement, they are saying if this level is below this level or not, level crossed. If this level is crossed, then compute MCC. Now, you tell me the moment this level crosses, you will raise funds again through three sources. What are the three sources? New debt, new preference shares, new equity shares. And new, so that means you are issuing new equity shares. At what price? Check. Assuming new equity shares are issued at 20 rupees. Okay, na? The cost of debt, any change are same. Same. We already found. Cost of preference shares also same. But equity shares, no, we have to recompute. Why? Sir, previously when we computed retained earnings, we took D1, we took market price as how much? 23.6. Now, are you issuing new equity shares at 23.6 or 20? 20. That means the price has changed. So, your cost of equity will be same as cost of retained earnings or it will change? Changed. So, tell me what is cost of equity ka formula? They have not given dividend paid. They have given expected dividend and growth rate is also there. Which formula for cost of equity? Gordon's model. What is the formula? D1 divided by P0 minus, don't forget flotation cost. It is not retained earnings. It is equity shares. For equity shares, flotation cost will not come or it will come. It will come. Whole thing added by the growth rate. D1 may any change or same? P0 is not 23.6. Now you are issuing new shares at what price? Now we are issuing the new equity shares at 20 rupees. So P0 here is 20 rupees. Flotation cost not there. Growth rate is still 10%. When you calculated, you got it as 15.9. Done, Aji. Now for this, we need to calculate MCC. Tell me how. Walk me through. This one, everyone okay, right? Walk me through the MCC process. MCC is also KO, but only for additional. Here, additional funds means what and all. First, tell me that breakup. Preference shares, debt, retained earnings or new equity shares. But weights are already optimum. Will it be changed or same? Weights are still same. Debt ka weightage is 15%. Preference shares ka 5%. Now, retained earnings or equity shares. Debt ka cost and preference shares ka cost we already calculated remains the same. But equity ka cost now is not. Earlier when we calculated retained earnings, we got it as 15%. Is it 15% now? This is retained earnings ka cost. Are we using retained earnings or cost of equity? What is cost of equity? 15.9. So take that. That's the only number changed. Weight same. Only equity ka cost changed. So MCC also will change. Same wala drama. This is a good question. Done, people. You need a minute to process anything or fine? So again, if you want to summarize this question, what are the takeaway? One, they said optimum capital structure. So the weights will change or same? Same. That is one. Then they, did we have retained earnings? Yeah. We had how much retained earnings? 11,800. What was equity retained earnings ka weightage? 80%. Of what? Total capital. So if you know retained earnings ka weight, if you know retained earnings ka amount, can you find out total capital? Yeah, how do you get total capital as a formula? Retained earnings ka amount divided by retained earnings ka weight. You did that, you got 14,750. Up to 14,750, we can just manage with new debt, new preference shares and retained earnings. Up to that level, equity shares, new equity shares need not be issued. But if you need any funds more than 14,750, now you have to issue new equity shares. For the balance amount or still the same weights? Still the same weights. What weights? Equity to the extent of 8, equity shares to the extent of 80%, debt to the extent of 15%, preference shares to the extent of 5%. That's all as a takeaway of this problem. Okay. This is okay. This one, 29th, I'll do it. I think that's all we have. One more, I'll do it over here. Okay, now people, do remember it's not the total number of questions we solve. It's about how much you have understood what interpretation basically. Formula to you need to mug up in FM. That is there. That is a pure memory exercise. But when you are applying, you should know what numbers to pick. D naught, D1, Gordon Chacha formula, IRR method, what? All these are subtle things. When you read the data, you should be able to interpret that. As long as you are able to interpret, it's fine. Okay? And don't freak out. Some people will be like, sir, ICI has released so many model papers, I have to solve each and everything. Not required. Right? First priority is, I feel always, study material ka questions. Every question. Last 2 to 3 attempts ka RTP, MTP questions. That is sufficient to crack the whole group, I'm saying. If you are a rank holder, if you are aiming for a rank, then number of times of revisions you need to increase. Instead of 1 revision, maybe you'll have to make 3 to 4 revisions minimum. Okay. And maybe do a few more questions with writing practice. If passing is your aim, 1 studies, 1 revision should be good enough. But don't blindly mug it up. When you are reading a question, now you should be able to, when you read this question, you should figure out. Now here they said convertible debentures. How your mind should work is, the moment convertible debentures andre concept, what? Optionally convertible, compulsory. Optionally means cash value redemption or share value redemption, whichever is higher. Compulsory means only share value redemption. Like this, you should revise each problem. With each adjustment, you are revising that whole concept again and again for yourself. And not just blindly reading and then figuring out, so when you are able to revise like this, even 1 problem if you revise, otherwise even 10 problems are not sufficient. That way. Okay, read this question carefully. A company issues 15% convertible debentures. Did they say anywhere there optionally? So far we have not seen. Fine. How much face value? 100. At par. Face value is 100. Par value means what? Face value itself. That means these debentures ka issue price is also how much? 100. Face value, issue price. Both are same. How much? 100. Maturity period 6 years. Sir, maturity period 6 years means it is not irredeemable. It is redeemable debentures. On maturity, each debentures will be converted. Optionally converted, Allah. Will be converted. So reading the line, I'm getting a feeler. It's not optionally convertible. It looks like compulsorily convertible. For compulsorily convertible, you will take 2 options ka RV or only 1. Which is that? You will take only RV of the share value. Share value. But subtle, small things. Will the debentures be redeemed immediately or after 6 years? After 6 years. Because debentures will get redeemed only on when the term of the debenture comes to an end. Term will come to an end only after 6 years. That means you need equity share ka value now or after 6 years. Since the redemption of the debenture will happen after 6 years, we need RV of equity shares not now, but after 6 years. Basically, we need market value of equity shares after 6 years. Keep that in mind. Now check. Risk-free rate of return is 10%. The moment risk-free rate comes, any formula uses risk-free CAPM model. Okay, so that means using CAPM model, we can find cost of equity. See, if you have all the data, RF is given. Market risk premium they have given. Risk premium andre RM minus RF directly. RM minus RF directly is how much? 18%. Calculate cost of equity for me. Beta is 1.25. How do you calculate? What's the formula? RF plus beta into RM minus RF. What is your calculator showing? 32.5 is the answer you're getting. 0.325 or 32.5%. All your calculators, I hope, is showing. Done now. Okay, what is this? 32.5. It is cost of equity. But I think we are not doing, are we worried about cost of equity here or debentures? Debentures. Okay, so far using CAPM, we got cost of equity. Done. Let's see. Now check. Sir, company has paid the dividend. Expected dividend. Company has paid the dividend. Dividend paid means a D1 or D0. So 12.76, what they have given is a D0. Okay. 5 years ago, it paid a dividend of 10 rupees. 5 years ago, how much dividend? 10. Now, after 5 years, it is 12.76. Sir, is dividend same every year or looks like increased? So here you tell me growth rate is not there or it is there? It is there. Okay, Naji. Now you can use trial and error method. 5 years back, how much was it? 10 rupees. So what you can do is first take in your calculator. 10 is there, no? 10, maybe first test it out at 5%. Add 5% five times. Why 5% you need to add it 5 times? Can someone tell me? 5 years ago, dividend was 10 rupees, no? I am testing if growth rate is 5%. So take 10 and add 5% 5 times. How much are you getting? 12.76. But that means 5% only is our growth rate. First guess only became right. Yes, like this. This is trial and error method. Test it out at multiple rates. If the answer matches 12.76, then that is the right percentage. That's your trial and error. Or in this problem, especially I would say, can you see these two tables? This is PVIF. Present value interest factor. 0.03 means 3%. T is for the time. So how many years ka PVIF they have given? 10 years. At what rate? 3%. Again they gave it for 5%. These two are your PVIF. This is your PVIF andre. This is PVAF. Present value annuity factor. PVIF means present value interest factor. PVIFA means present value annuity factor that they have given. This is your present value table. Just like present value table, you also have future value table also. Now, whenever they give you, forget about this, whenever they give you future value table, I would suggest to find growth rate like this. How? Very simple. Sir, how much was the dividend now? 12.76. How much was the dividend 5 years ago? 10 rupees. So, what is the latest dividend? 12.76. How much was the dividend 5 years ago? 10. Take the latest dividend divided by the earlier dividend. Latest divided by the old. New divided by old. What are you getting? 1.276. 1.276. So what you have to do is, you have to look for this 1.276 in future value table. Find 1.276 in this future value table. Check. Where is 1.276? Here. Here. Correct? At what rate? 5%. At what rate? 5%. This here is your 5%, this is your 6%, this is your 7%. So that means this 1.276 is matching at which percentage? It is matching at, in fact, this is 5 years, this is actually 5 years. Okay, that's okay. 5 years, 6 years, 7 years. So this is matching at what rate? 1.276 is matching at 5%. So therefore, growth rate is what? 5%. How I want you to write is, do this and then say, referring to future value table. Referring to future value table, growth rate is 5%. Like this, I would suggest you to present an exam. When future value table is given. If this table is not given, then you can do trial and error. And simply write growth is equal to 5%. In bracket, may you write trial and error. If this future value table is given, ideally, I would recommend you to use this info and then get the growth rate. How to do this? Tell me. Latest dividend divided by old dividend. And look for that number in future value table. Whichever percentage it matches. As simple as that. Okay, na sir? So growth rate we got. How much is growth rate? 5%. Dividend expected they've given or dividend paid they've given? Dividend paid. How much? 12.76. Growth rate we got it as 5%. Next, what information they've given? Flotation cost is 5%. Okay. Now, one minute. Hang on. Flotation cost of the issue amount. Sir, are you issuing equity shares now or are you issuing debentures? Don't forget, we are not issuing equity shares here. Company is issuing what? Convertible debentures. I mean, this is the flotation cost of equity shares, Allah. This is the flotation cost of the debentures. Goinda, got it. Everybody. Pakka no? So, this is the flotation cost of the debentures. Pakka ji. Now, people, but they gave information relating to cost of equity. Whenever you feel I've given too much of information, I don't know what to do with. No problem. First solve. They gave CA PM ka data. So what did we get from that? Cost of equity. Now looks like they've given growth rate and all means it is Gordon Chacha. Gordon Chacha ka D naught ka formula you tell me because they gave dividend paid. So D naught ka formula you tell me. Full you tell me. Cost of equity is equal to D naught into 1 plus growth rate divided by P naught minus flotation cost. Flotation cost don't take Guru 5%. This flotation cost is for debentures, not equity shares. So for flotation cost, you cut off. Whole thing added by growth rate. How your mind should run is, we already found out cost of equity using CAPM. That means now when you substitute this cost of equity in Gordon-Chechaka formula, you will get P naught. Because P naught is not given. P naught means current market price of the equity shares given a missing R. So that is what you need to find here. See, that's what I've written over here. First use, leave this. First you use CAPM model. When you use CAPM model, how much did you get cost of equity? 32.5. Growth rate, we already know. How much is that? 5%. What is Gordon-Chechaka formula? D naught into 1 plus growth rate divided by P naught. Flotation cost is not there because we are not issuing equity shares here. Whole thing added by growth rate. Now, do you know D naught? Yes. Do you know growth rate? Yes. Do you know cost of equity? Yes. What you don't know? P naught. P naught is your current market price. That means when you substitute, you will get P naught as a balance. That is your current market price of the share. Yes, sir. Either you can use a substitution formula or there is a formula for P naught only. We have done in the dividend decision model. What is the formula? Another formula. If you want to find directly P naught, the formula is D naught into 1 plus growth rate divided by K minus G. We have used this in dividend decision. It's a pure substitute. We want P naught. No. Send G to the other side. It will become what? K minus G is equal to D naught into 1 plus growth rate divided by P naught. Send P naught to the other side, cost of equity to the denominator. So what will be your formula? D naught into 1 plus growth rate divided by K minus G. It's a pure substitute formula. Done, sir. Using this, now what we can find out? Price of the equity shares. Understood the flow of the problem? Again, walk me through. What is the first step? Using CAPM model, we found out cost of equity. Using Gordon-Chechaka formula, now we are finding P naught. P naught of what? P naught is current market price of the equity shares. Why do we need this? Because it's a convertible debentures. When you convert the debentures, we will not give cash. We will give equity shares. So you need equity shares ka value. That was not given. So we use this to find. Okay, now. That means what is the redemption value of the share option? 48.72. Correct or wrong? Why? Sir, this is the current market price. Is the debenture getting converted now or after 6 years? After 6 years. And what is the growth rate, Chacha? Or you are not Chacha. What is the growth rate, Macha? You are Macha. What is growth rate? 5%. Current market price is 48.72. Growth rate is 5%. And what is the period? 6 years. Now, if the price of the share is 48.72 and if the share ka growth rate is 5%, after 6 years, what will be the price? You simply can do shortcut way. What is that simple way? Take the current market price, add 5%. How many times? 6 times. Because you want the market price after 6 years. Or you can use your mathematics future value formula. What is future? How do you find future value? Present value into 1 plus I whole power n. That also you can use. In math foundation, maybe we used to use this. No? You can use this or simply add this. I would suggest this easy. Right? So what is the price of equity shares after 6 years? 65.28. This is what we wanted. This was the whole drama of this particular question. Not given. Remaining part of the question is nothing. This is the main impact. Okay, now. But hang on. They would also give one more. Sir, what is the 65.28? Market value of 1 equity shares. Market value of 1 equity shares. But we are converting what here? Debentures. When you convert debentures into equity shares, for 1 debenture, is it compulsory to issue 1 equity shares or company choice? So what did the company wants to do here? Check. What did they say? Where is it, pa? Somewhere we saw it. On maturity, each debenture will be converted into 2 equity shares. That means if you are owning 1 debentures, you will not get 1 share. You will get 2 equity shares. Yes, sir, people. And this 65.28, what you got is the market value of 1 equity shares. Are debenture holders getting 1 equity shares or 2 shares? So what is the share option ka redemption value? 65.28 or 65.28 ka 2? To why 2? Because on 1 debenture we are giving 2 share. So what is the redemption value of the share option? 130.56. Done. Now use this data in your approximation method ka formula. Now it's simple. See, interest amount missing or given? Given. Tax rate is also given. RV, just now we got it. What is RV? No, just 130.56. Minus net proceeds. They told in the problem these debentures are issued at par. Yeah, par value. So that means how much is it? How much is net proceeds? First priority for NP. If it's a, sir, we are companies issuing the debentures. So if it's a new debenture, first priority for IP. IP of the debenture missing or given? Given. Yes, sir. So that means net proceeds is how much? 100 or flotation cost. Don't forget flotation cost. How much is that? 5%. 5% of what? Issue amount. How much did you issue the debenture for? 100. 100 ka 5% you do. How much is that? 5 rupees. So that means that's what I've written it over here. Issue price is 100. Flotation cost is 5 rupees. So net proceeds will be 95. N is 6. Substitute and you will get the cost of debt to be 13.23. This is very, very easy stuff. The only crux is to find out the RV. And that too, they had not given price of equity shares. Usually in problem, current market price of equity shares will be given. Here, they asked us to find that. How did we find? First, cost of equity through CAPM. Then again, we find market value of equity shares through Gordon's formula. That was a current market price, but debentures will get converted into equity shares after 6 years. So we need a market price of equity shares after 6 years. That will be the market price of equity shares of 1 share. Debenture holders are not getting 1 shares, they are getting 2 shares. So multiply and then you will get the distribution value. That way, that's what makes this question a little better, I would say. Okay, sir. All right. I think we have one more part of the question that is simple. Preference shares also we have issued, redemption, and these are convertible. No. I mean, is there any drama here or straightforward? Straightforward. They are asking us to use YTM method for preference shares. Again, that also we are comfortable. So second part of the question is repeat, nothing much to learn. Only first part of the question was what made this question interesting enough. Okay, sir. Everybody good, sir? All right. I think that's all the time we have. Yeah, should be good. Fine. 2 minutes, you want us to recap the whole thing once again? 5 minutes? Would you think constant recaps is helping you? If it helps, we'll revise and we'll take a break. Otherwise, if you have got it, means I'll wind up. Revise once, I don't mind multiple revision. That's my second name. Okay. Chapter name. Cost of capital. Capital here refers to long-term source of finance. Each long-term source of finance, we are trying to find out the cost. Okay, sir? And that is one no. First, cost of debt. Cost of debt, you need to first ask yourself one question, whether it is redeemable or irredeemable. If it is irredeemable, cost of debt is given by the formula interest into 1 minus tax rate divided by net proceeds. Net proceeds, what do you take? First priority for net proceeds is, first you need to check whether it's a new issue or existing. If it's a new, first priority you will take issue price. Issue price missing, market value. That is also missing, face value. If it's an existing instrument, first priority market value. That is missing, face value. If you are not able to find out whether it is a existing or a new, then first priority is still IP. IP missing, market value. Market value missing, face value. But no matter what you take, flotation cost compulsorily you have to reduce it. And flotation cost can be calculated on face value or IP, MP depending on the question. If they don't tell anything, calculate flotation cost on the issue price or market price. If they say calculate flotation cost on face value, then only calculate on face value. That is one. Next, if it's a redeemable debt, the formula will be interest into 1 minus tax rate plus RV minus NP divided by N. Whole thing divided by RV plus NP divided by 2. RV is your redemption value. N is your not total life. N is the remaining life. These two methods we call it as approximation method. There is another way to find out cost of debt, that is your IRR method. Here we'll have to assume 2 discount rates and assume and apply interpolation formula. Interpolation formula is lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. Okay. Now at year 0, you will take net proceeds as a negative number. Then after tax interest for whatever the term. At the end of the term, you will take redemption value. After tax interest and redemption value will be in positive. Net proceeds will be in negative. And directly do it. If you want, first you can solve under approximation method and then assume the discount factor. That is totally your choice. Then if it's convertible debentures, first you will ask a question whether it is compulsorily convertible or optionally convertible. If it's optionally convertible, then you will take cash ka redemption value or share ka redemption value, whichever is higher. If it's compulsorily convertible, you will only take share ka redemption value. Okay, then we went for preference shares. Same drama, substitute interest with preference dividend. You'll take after tax or no after tax. So that means if it's irredeemable preference shares, formula will be preference dividend divided by net proceeds. If it is redeemable, preference dividend plus RV minus NP divided by N, whole thing divided by RV plus NP by 2. Or you can use IRR method. If you're going for IRR, at year 0, you will take net proceeds in negative. Then you'll take after tax dividend, after tax preference dividend or only preference dividend. Only preference dividend for the duration. Then at the last year, you will take redemption value. Preference dividend, redemption value positive, net proceeds in negative. And then apply interpolation formula. In equity shares, so equity shares ka dividend price approach. Dividend divided by price. This method assumes dividend to be constant. Earnings price approach. EPS divided by NPS. Assumes EPS to be constant. Gordon Chacha. D0 into 1 plus growth rate divided by P0 minus flotation cost. Whole thing added by growth rate. If the D0 is dividend paid, G is your growth rate. P0 is same. If it's a new shares, first priority, IP. That is missing, market value. If it's existing share, first priority to market price. If they've given D1, the formula will be D1 divided by P0 minus flotation cost, whole thing added by growth rate. One way to find out growth rate is trial and error. Another one, current dividend, latest dividend divided by old dividend. Look for that number in future value table. Or B multiplied by R. B is your retention ratio. R is your rate of return on investment. Another way. Then the CAPM model. Cost of equity as per CAPM model is RF plus beta into RM minus RF. RF is your risk-free rate of return. B is your beta. RM is your market rate. Sometimes they'll directly give you risk premium. Risk premium means RM minus RF. Okay, then we looked at yield to maturity approach or realized yield approach. For that, first check year-wise return given, not given. If it is not given, IRR method. If it is given, first year return 1 plus Y1 is equal to D1 plus P1 divided by P0. Second year return denoted by 1 plus Y2 given by D2 plus P2 divided by P1. Third year return denoted by 1 plus Y3 given by D3 plus P3 by P2. Fourth year return 1 plus Y4 given by D4 plus P4 divided by P3. Multiply all the 4 years return, find out fourth root. Press the square root buttons basically twice. Minus 1 you do, it's a geometric mean, you will get the cost of equity. Then cost of retained earnings formula is same, but don't use flotation cost. If you're using Gordon Chachaka formula for cost of retained earnings, don't do flotation cost. Rest everything is same. Then cost of retained earnings is also given by cost of equity into 1 minus flotation cost into 1 minus TP. TP as in personal tax rate. Then what did we learn now? Marginal cost of capital. Overall cost. 1 second. Then we looked at overall cost of capital, WACC, denoted by the symbol KO. And for this, how do you find this? Take that instrument ka cost multiplied by that instrument ka weight. And this weight can be either calculated using book value or market value. First priority is market value as it is the latest information. Book value is old info. Alright. MCC is also same. Calculation is same. But we are finding the KO only for the additional capital. Right? And is there a way to find out the total capital using retained earnings? When they say optimum capital ratio is this, how do you find that? Take retained earnings ka amount divided by retained earnings ka weightage. That will give you total capital. Then next, sir, if company ka interest rate and market ka interest rate, if it is not sinking, then debentures will have to be issued at discount. How do you find out the issue price in that case? Actual interest amount divided by the expected interest rate. That is one. And don't forget to reduce flotation cost. By doing this, you can only get IP. How do you get NP? Issue price minus flotation cost. And then, is there any shortcut method to find out KD? When RB, NP are same, then should you have to use a big fancy formula? No. Take the interest rate, multiply 1 minus tax rate. For preference shares, what is the shortcut method? Preference dividend itself will be your KP. Okay, I think that's pretty much what we covered. All right, people. Thank you.